New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today.
Happy Friday, everybody. The latest read on inflation, the Producer Price Index, PPI in your hood, slowing on a month-over-month basis, but ticking up from the prior year. This comes after September's CPI print came in hotter than expected. Traders now pricing in higher odds of no cuts at the next meeting. 14% today versus 2.6% a week ago. That's the probability.
And third quarter earnings season is underway. Two big banks reporting this morning before the bell. First up, JPMorgan beating the street's expectations on both the top and bottom lines. Net interest income surprising to the upside, and the bank raising its outlook on that metric for the year. Despite all that, we are trading just below the flat line here ahead of the open. And then flipping over to Wells Fargo, a move higher there in shares, posting though mixed results. A rise in investment banking fees partially offsetting that drop that we saw in lending revenue.
And Tesla unveiling its long-awaited $30,000 autonomous cybercab Thursday night. CEO Elon Musk arriving at the event inside of the robotaxi. The vehicle features 2 seats, no steering wheels or pedals, as it's designed to be fully autonomous. Tesla will start trials with the cybercab next year and expects it to be on the market sometime 2026. Musk also unveiling a larger autonomous robo-van designed to transport a lot more people. The event's not enough to satisfy investors. Tesla shares slipping this morning pre-market.
JPMorgan and Wells Fargo kicking off earnings season. Focusing first on JPMorgan, we're seeing a bit of a divergence here in the reaction to shares pre-market. First of all, you're looking at JPMorgan off just about 0.5%. The company posting a surprise gain in net interest income and raising its forecast for the year. The stock still searching for some direction ahead of the open. A couple of takeaways here within this report, Brad. We are seeing a bit of pressure. They did have a drop in profit compared to a year ago, but net interest income helping to offset some of that disappointment. Also, the rise in investment banking revenue, the fees there surging 31% from a year ago. That was something that has been called out in the quick reaction here this morning to these prints. And then some commentary here from CEO Jamie Dimon. We know there's always a lot of focus on where he sees the direction of the economy, how confident he is in the economy up until this point. He did say that he remains optimistic about slowing inflation. He is very confident in the resilient U.S. economy up until this point, but that wasn't couched or wasn't without being couched by some of the uncertainties that certainly do lie ahead. He talked about the geopolitical unrest. That is something that he is very much watching here, calling it one of these several critical issues that do remain. He also went on to talk about the large fiscal deficits, infrastructure needs, and restructuring of trade and remilitarization around the world. So he does remain confident in the Fed's path ahead and where the economy does stand at this point, but it wasn't without some of those warning signs. And you can see JPMorgan now in positive territory as investors are digesting this commentary and trying to figure out ultimately what this means for the bank moving forward.
Yeah, and as we're thinking about what was anticipated coming into this quarter, it was anticipated that you would see a boost in investment banking. I'm looking at one of the notes from Moody's Ratings, and this was released coming into the start of the bank earnings season here. And they said Q3 earnings would likely reflect strong trading revenue and a boost in investment banking, going on to saying trading volumes were robust in cash equity and equity derivatives markets, plus implied volatility spiked significantly as bid and ask spreads widened. So that benefiting some of the investment banking divisions at these major banks here. One of the banks that I'm tracking and looking at this morning is Wells Fargo here. Taking a look at the company actually rising here pre-market despite a mixed bag. Third quarter profit, that topped expectations, but the bank trimmed its full year outlook. But the earnings beat is enough for investors here. The stock rising ahead of the open, as I mentioned, and I got kind of 3 takeaways from this report. One is the profit topping expectations here, as you saw that come in better than expected, directly passing through to that adjusted EPS line. 2, net interest income, that missed, and ultimately you saw that decline year over year by about 11%. This was pretty early in the earnings call, or in the earnings release call out here. And then just lastly here, when you think about the increased emphasis on the fee-based revenue. This is something that has been kind of a restructuring, at least in the profit profile for the business, as the CEO, Sharf, has been looking to diversify the business even more so, really talking about some of the investments that they're making to diversify where those revenue sources are coming in from, looking more towards some of these fee-based opportunities here, and that's certainly contributing. That was up by about 16% year over year.
Yeah, and you can see as investors are evaluating these results, very encouraged by some of this commentary coming out from Wells Fargo. I also want to pull up quickly a chart that stuck out to me this morning. It was sent by Apollo's Torsten Slack. And as we're discussing bank earnings this season, of course, a big question that's top of mind here for so many investors is ultimately what the rate cutting cycle means for financials specifically. And he put this in context of what typically happens during past soft landings. And as you can see, he broke it down by sector outperformance, or sector performance, I should say. And you can see where there is outperformance is from financials. Financial sector was up just about 39%, the second top performing sector in those past rate cutting cycles where we did see a soft landing. You might be wondering when that was. He's talking about from July 1995 to January 1996, also September 98 to November 98. So what does this set us up to see? And maybe this also speaks to some of the confidence that we're hearing from these bank executives out this morning. Now that we are in this rate cutting cycle, the econ data has been holding up. Looking at the early commentary, especially from Diamond, remaining quite confident in the resilience of the U.S. economy. So if that does, in fact, turn out to be true, and we are able to orchestrate, the Fed is able to orchestrate a soft landing, we could then see higher highs here for some of these big bank names.
I love when Jamie Dimon puts on his economic weatherman hat.
He always does.
Absolutely.
We will be diving in deep into bank earnings later this hour. We'll be speaking with Chris Whalen. Whalen, a Global Advisors Chairman, at 9:40 a.m. Eastern Time. That's a conversation you won't want to miss. Producer prices for the month of September coming in flat, slowing from August's read. On a yearly basis, the index, though, did tick up just a bit. S&P and Dow futures trading just around the flat line. You've got NASDAQ futures slightly lower here, off just about, looks like the NASDAQ on track to open off just about 0.3%. We want to bring in Stephanie Roth, a chief economist at Wolfe Research. Stephanie, it's great to have you. So we've got the PPI data out this morning. Of course, we had CPI earlier this week. I'm curious how you're looking at this data and whether or not this really moves the needle at all for the Fed.
Yeah, so today's data was okay. At the margin, it actually was a little bit more hawkish than at least the headline print would suggest, because what really matters for the PPI is the components that go into the all-important core PCE index, which is what the Fed targets. So today's data actually was a little bit stronger for some of the key components that go into that PCE index. So things like household insurance, nursing, hospitals. So for those, actually it takes up our core PCE estimate. So right before the print, we were looking for about 0.25% on core PCE. Now it's looking like it could be a little bit hotter, which is higher than what the Fed is looking for. So if you take a step back, we do think that the Fed is able to cut at the next meeting, but it's a toss-up and perhaps a bit higher than what the market is anticipating at the moment.
They're able to, but do they need to?
Well, rates are still high relative to neutral, so they certainly should be cutting from here. Could they have skipped the meeting in November? Of course, but it probably looks a little bit strange to go 50 basis points and then skip a meeting, but they certainly could. I do think that we'll have some skips in store, perhaps not this year, but perhaps at the beginning of next year.
Stephanie, when you take into account some of the other big events that have been happening this week, we've been closely tracking the developments out of Hurricane Milton and the destruction that it's left in its path. We saw the impact of past hurricanes, Hurricane Helene, on the jobless claims number that we got out yesterday. I'm curious, when do we typically see a peak? Are we likely going to see maybe elevated readings on that jobless claims number over the next couple of weeks?
Yeah, the data are going to be really messy from here. And that's one other reason why it's more likely than not that the Fed will be cutting in November, because the employment data are likely going to look fairly weak. And it's hard for them to discern exactly what's attributed to the hurricane, even though they know that there will be an impact. So what tends to happen is after some significant hurricanes in the past, you've typically had a rise in claims for the couple of weeks after the hurricane. It tends to peak roughly 2 weeks after the hurricane hits, probably because there's power shortages, and that's not maybe the filing an unemployment claim isn't necessarily the first thing that somebody would go about doing. But in the couple of weeks after the hurricane, you do tend to see that spike. So we're likely to see higher unemployment claims for the next couple of weeks, likely through much of October. And the employment report is certainly going to be impacted too. If you rewind back to what happened in Beryl, The BLS said there was no discernible impact, but if you look at the state data, there was a significant drag from the state of Texas. So we're expecting a softer reading kind of across the board, and it's going to make it hard for the Fed to sort of pause just because we don't know what's impacted by the weather and what's slowing in the economy.
Yeah, and that's a footnote, or not even a footnote. It's usually within the first page of the BLS monthly report too. Once we get those updates and acknowledge what some of the damage has been, especially on the employment situation front after some of these events. All that considered here, what is the underlying strength that you're seeing right now in the employment situation that the Fed is going to be monitoring most closely?
Yeah, I mean, we first just looked at unemployment claims before all of the hurricane impacts. They were really quite steady. You see consumer spending really quite strong. So that was at mismatch with what we were seeing from the jobs report, at least as of before last Friday. So it looked like there was a slowing in the payrolls employment report, but that wasn't met elsewhere in the economy. And to us, that signaled that there was kind of a discrepancy there. You don't really have really strong spending if economic employment is slowing pretty materially. We would lean on the spending data to some extent, and that's kind of what played out. You got big upward revisions to the payrolls data. The 3-month trend is now 186,000. As reported through the month of July, it was just 116. So there was a pretty big upward revision to the trend in terms of payrolls growth. We think that's closer to the reality. We think payrolls are trending around 150,000 per month, which is in line with what it was in the last cycle, which was a very solid hiring expansion.
Stephanie Roth, who is the chief economist over at Wolfe Research. Stephanie, always a pleasure to get some of your insights. Thanks so much.
Thank you.
Certainly. Well, Tesla showing off its long-awaited Cybercab at the company's first product unveiling since 2019. Yahoo Finance's Pras Subramania is here now with more, with 3 of the biggest takeaways from the event. 2019, really? Was that how long ago Cybertruck was?
That was the Cybertruck,
wow. Okay.
reveal event. There have been other events in between, but I guess not a major product. But yeah, I mean, a couple of things here. I mean, obviously, you mentioned the Cybercab. It's actually here. It's actually real. It's not an AI-generated image. Musk got a ride in it to the actual event stage. So we got to look at that kind of diminutive little like Cybertruck-esque looking pod-shaped thing. No scissor doors, which is pretty cool, but no pedals, no wheels. Our steering wheel, trying to really go for full forward here with a robotaxi. The question is, is it fully ready? How long is that going to be? 2026, 2027 is when they might produce the vehicle, so we'll see about that. And also for $30,000. That's another thing we'll see about that, right? What else caught my mind was the robo-vans. At the end, they pulled out the robo-van, which is this monolithic-looking cargo thing that can hold 20 people, no windshield, no visible wheels. Sort of like out of like Blade Runner, the movie, right? So there it is right there coming on stage, and 20 people kind of got out of it. So that thing was a little bit of a surprise. Again, no details on how much it's going to cost.
It looks like it's out of Back to the Future.
Yeah, I think Kara Swisher called it a toaster. So we'll see what the deal is with that. Is it just pure vapor where it's never going to come out? We'll see. Finally, for me, the big takeaway, there was no Model 2, right? There was talk of that. They might reveal this cheaper Tesla EV, a sub $30,000 EV, that volume vehicle that Tesla needs to sort of really get back on that growth train. We didn't see that. Now, it's possible that Cybercab might be the underpinnings for that Model 2. It might share some components, maybe the body. So we'll see if that's actually the case. But Tesla said we'd see that vehicle by the end of this year, and time is running out. So that was a big question mark for me.
Yeah, and I think also the big question is just how realistic these timetables are just overall. And I think that's also reflected in the stock price that we're seeing here this morning.
Yeah. We always knew it was going to be a solid news event, right, because of just the expectations and things like that. But, they say they're testing unsupervised FSD in California and Texas next year. How far along is that software? Where's the ride summoning app? People were asking, why haven't we gotten to see that or use that to summon the cars at the event? So that's another big question for people.
All right, Pras, thanks so much for breaking that down for us. We want to stick with Tesla because of the share reaction that we're seeing this morning. Elon Musk making those big promises at Tesla event last night, but can the company actually deliver on those lofty expectations? Joining us now, we want to bring in Garrett Nelson. He's an analyst with CFRA. And Garrett, it's great to talk to you. Our autos reporter Pras was just breaking down the biggest takeaways from the event last night. And when you take a look at the street's reaction this morning, investors clearly are not satisfied with what they heard. What do you think it is that's dragging the stock lower? Is it the lack of details?
Thanks for having me. We think that's exactly it. We were really disappointed by the lack of detail Regarding their near-term and intermediate-term product roadmap, again, as Pras said, no mention of the more affordable EV model. A lot of people calling the Model 2. Nothing about that. Nothing about the Roadster. Both of those vehicles, if you look on the last conference call, Elon Musk said that they would be in first production, sometime next year. So, the event was sort of like watching a movie with a lot of plot twists and special effects. And at the end, you're walking out, kind of scratching your head. You're talking it over with your friend, trying to figure out what you just witnessed. So, and we had to rewatch it at the end of it just to kind of make sense of everything. But it was really short on detail and long on special effects, kind of what we were expecting, just given the setup with the event being held at the Warner Brothers studio in Burbank.
Oh, Garrett, the fact that you rewatched it again, it must have been a very, very late night for you last night. But Garrett, when you see the type of reaction that we're seeing this morning, is this just the start of a bigger sell-off, do you think? Garrett?
Oh.
All right, we're having some issues with Garrett's connection. Do we have him, guys?
Sorry, I
okay.
lost you there for a second.
No worries, no worries. I was just talking about the fact that we're already seeing this type of the significance of this reaction with the stock off nearly 7% ahead of the open. Do you think that this is just the start of a much larger pullback here for Tesla?
It could be. You look at the dramatic run up in the stock really ever since April. In July, we moved to a hold, just given this massive multiple expansion that we've seen in the stock. If you look at where it's trading on consensus estimates, the stock, where it closed yesterday, is trading at 75 times consensus estimates for next year. Looking out to 2026, it's trading at 57 times. So these are really pretty lofty multiples. And here we're left with a lot of questions regarding how it's going to achieve that earnings growth that is embedded in expectations over the next few years. Like they said, the RoboCab, you're talking first production, by 2027, but that doesn't do anything to really clear up the intermediate term, which was our big issue with the story. And as you know, I've been a longtime bull on Tesla. We're much more cautious here. We have been since July, just given the lack of clarity, the lack of transparency as far as what's going to drive the earnings growth over the next few years. This is a high growth stock whose growth has really hit a wall here recently.
And so with that in mind, I mean, even bulls like yourself have had to acknowledge the history that Elon Musk and Tesla have of not meeting timelines that they communicate to the street, as kind of, luscious and amazing as they might seem, tied to the products that are being unveiled. At what point do you have to say, okay, we need to trim our expectations of what Tesla is actually going to produce that investors can rely on to be directly translated to shareholder value?
That's a good question. And what Musk has been really good at is keeping investors focused on the long term, products that are several years out, maybe even a decade or more out. And so, he's continuously, if you look back, a decade ago, he was promising fully autonomous vehicles only a year or two away. Here we are in 2024, and it's still, that we think Tesla is still a ways away from that. So, but it remains to be seen. Are investors going to be focused, looking out many years? Or are they be looking at the intermediate term and at estimates, which I think are probably too high and are going to have to come down, just given the realities of slowing EV sales and a lot of lack of transparency regarding the near-term product pipeline. Is the new mass market EV model still coming next year? Is the Roadster coming? We're left with more questions than answers after the event last night.
And so with the lack of clarity in that product pipeline, as well as timelines around it, who's the biggest winner if Tesla doesn't deliver on some of those items?
That's a good question. I would argue other automakers are winner. If Tesla loses, then other traditional automakers, many of whom are also working on autonomous driving products. Perhaps GM with the GM Cruise, Waymo. Those Uber. Those companies are probably winners, just given the disappointment here following this event.
Garrett, great to have you here this morning. We're tracking shares of those automakers, tracking shares of Uber right now, jumping even as perhaps there's a sigh of relief over in Daraland right now. Garrett Nelson, CFRA analyst, thanks so much for taking the time here.
Thank you.
Appreciate it. Everyone, coming up, Bank of America, AMD, and Trump Media and Technology. We'll talk about some of today's top trending tickers on Yahoo Finance after the break. Plus, we've got the opening bell on Wall Street. We're bringing you today's market action. Stay tuned. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, we've got Bank of America getting dropped, slashed, trimmed a little bit by Warren Buffett and Berkshire Hathaway cutting their stake in the bank below 10%. Now this is critical. Berkshire has unloaded a total of 257 million B of A shares over the past 13 weeks. Still, it remains the bank's biggest shareholder with 775 million shares worth about $31 billion. But this puts it below that threshold of 10% where it's required to actually disclose to the SEC some of its trading that it's doing within the name.
Yeah, and we asked McCrae Sykes, he was of Gabelli Funds earlier this week. One of his picks was Bank of America, and our colleague Madison Mills asked him about whether or not Berkshire and Buffett selling their stake or continually selling their stake in Bank of America, whether or not that was looked as maybe a worrisome sign. And he said, obviously, you never want to see the largest shareholder there continuously selling his stake, but he did note the fact that these were for many of one-off reasons, that the bank is still in solid shape. Yes, it has had a massive run-up since Buffett specifically started buying, so he has made a ton of money on this bet. So it's not necessarily a reason there to sell the stock. And I think that also explains why we aren't seeing maybe the degree of the reaction that you initially probably thought that you would, given the fact that this has been so continuous and we have heard about it so many times. But I think you're exactly right. It's now below that 10% threshold. That is not something that necessarily comes as a surprise, especially on the heels of the continuous selling that we have seen over the last several weeks. So we are seeing Bank of America here in extended hours still actually moving to the upside, up just about 1%.
October 15th is when those earnings drop, so we'll hear a little bit more from the bank at that point.
We certainly will. And we're going to have that for you right here on Yahoo Finance. All right, let's switch gears and talk about the chip sector. AMD unveiling its latest chips during its Advancing AI event yesterday, expecting to start mass production later this year. But some analysts, they're not so much impressed. CFRA saying it doesn't think it will make a dent in NVIDIA's shares, and Jeffrey saying that it wasn't a thesis changer one way or the other. On the other hand, KeyBank saying that it is encouraged by the updates and confident that the company will be able to remain competitive with NVIDIA. And it was a KeyBank commentary that really stuck out to me because we have seen this outperformance here in AMD, some excitement, especially on the heels with NVIDIA. And I think that was the big question about whether or not they were going to be able to maybe chip away at that market share and better compete with NVIDIA. So maybe while this might not be a total game changer for the investment thesis, KeyBank at least is seeing some reasons to be positive and thinking that at least AMD is going to be able to remain competitive with the leader within the space.
Yeah, our own Dan Halley, a tech editor, was covering this yesterday, and one of the major takeaways that I saw him publish in the story that he put up on the Yahoo Finance platform, everybody could check out, AMD wants you to know its chip can outpace Intel's in certain scenarios. So it's really kind of choosing who they're going head to head against right now. And if they can gobble up, at least take some of that market share away from Intel, as Intel is in its own quandary of questions right now, trying to figure out the investment strategy and building up and ramping up fabrication at the same time, where some of the investor sentiment is growing a little wary on that transformation story. Of course, AMD trying to swoop in and not just prove that they can compete up against NVIDIA, but also perhaps take some market share away from Intel as well in the same swoop here. Also, finally, we got to check in on ticker symbol DJT. Trump Media on track for its best week since it was listed in March, reversing a steep sell-off in recent weeks with less than a month to go until the presidential election here. If you're taking a look at shares right now, they're up by 9% here pre-market. What's probably critical to also note here is that they hit a new all-time low last week. So it's really rallying off of a new trough.
Yeah, that's one way to put it. I mean, we have seen the massive rally in this name. I think the way it trades, obviously, it's not in tandem with fundamentals. That's something you and I, Brad, have talked about time and time again. When it comes to, you might be asking yourself, what is driving this momentum? Because we know very much it has traded with any sort of increasing or decreasing odds of former President Trump being elected in November. I think it kicked off over the weekend with the appearance of Elon Musk at the Trump event. Clearly, that added some excitement. That's how we started the week with DJT. That has carried over throughout the week. And I think going forward, there was also this was interesting to me. When Vice President Kamala Harris was also on 60 Minutes, the fact that she was grilled just a little bit, pressed on some questions, there was also some reaction that maybe that could have been helping shares as well this week. But I think when you take a look at that massive run-up that we've seen, obviously well off the highs that we saw shortly after this started publicly trading. But again, when you take into account the massive run-up, I don't think there's too many that are very convinced that's going to be a straight road higher, right? It's likely going to see a lot of volatility as we lead up to the November election.
Yeah, well, the great thing about this company, publicly traded, so we'll get some earnings at some point and we'll see what gets disclosed and communicated to the street, and then we'll have even more of an opportunity to discuss whether or not it's actually going to reattach to fundamentals. But since we're talking about one of the driving forces behind this name, former President Trump going after Fed Chair Jerome Powell after after inflation data came in hotter than expected this week. Yahoo Finance's Ben Werschel joins us now with more on this and his comments as well, and what it could mean for the Fed here. Ben, take it away. What could this mean, essentially, especially as you've already had former President Trump saying that the president should have more of a say, or he would like to have more of a say in the actions of the Fed?
Yeah, for sure. Just like the Donald Trump stock, where we're tracking the Donald Trump remarks on the Fed. And what we saw this week was kind of one of his more direct critiques of the Fed in general and Jerome Powell that we've seen in a while. He said, I have it right here, it was too big a cut, and everyone knows it was a political maneuver that they tried to do before the election. That's in response to the inflation report. And Trump has sounded some of these notes before, but this is a much more unadulterated version of it than we've seen in a while. And it does kind of put into highlight of how he might approach the central bank if he wins. This comes as there's a lot of ideas floating around Trump and his orbit that could kind of rein in the Fed. Rein in Fed independence if he wins. One we saw just this week was an advisor named Scott Bessent, who's very close to Trump. Trump name-checked him even this week, who's talking about a shadow Fed governor. It wouldn't be firing Powell, which is another idea that's out there, but it would be installing kind of a shadow governor that would offer forward guidance. So it's a lot of ways that Trump and the central bank could kind of come head to head in a way they even did last time if he wins again in the fall.
All right, Ben, thanks so much for breaking this down for us. Really appreciate it. We're going to continue to watch shares of DJT as well as monitor the latest out of the Trump-Powell spat here. Yahoo Finance's own Ben Werschel.
Talk to you later.
Talk to you later. Everyone, we were just watching the opening bell at the NASDAQ and at the NYSE, and we had some familiar faces ringing the opening bell. The man with the leather jacket, there you see him, Jensen Huang, ringing the opening bell, CEO of NVIDIA over at the NASDAQ there, right by the president and CEO of NASDAQ, Adena Friedman. Let's take a look at how the markets open up here on the day. Largely watching for the Dow Jones Industrial Average, some gains, slight gains at the open here. We're up by about 0.2%. The NASDAQ Composite, though, you're seeing that down out of the gate this morning. It's lower by about 0.4%. And then split toss-up here for the S&P 500. You're seeing that flat just barely to the upside at this juncture. Let's take a quick look at some of that sector activity out of the gate here this morning as we begin today's trading activity. I'm taking a look at more green than red, and that's a good thing. However, a bad thing for consumer discretionary. That's down, bringing up the caboose by about 0.9%. Utilities also lower by about 0.4% early in trade. And as we begin the bank segment of earnings season, the financial sector right now, XLF, you're seeing that up by about 0.9%. Shauna?
All right, Brad, let's kick it over to Jared Blickery, who's standing by in the newsroom with a closer look at some of this movement that we're seeing at the mixed open. Jared.
Well, thank you, Shauna. So we are heading for 5 weeks of straight gains, not only the Dow, but the NASDAQ and also the S&P 500. And you can see this is 4 days. Let's put it up to 5 days behind me. S&P is going to notch gains of about 6% or 0.6%. But I don't want to bury the lead here. We are at the second anniversary, 2-year anniversary of this bull market, which began basically at the October 12th lows of 2022. And if you do the math, it might be next Monday, which is Indigenous Peoples Day. Anyway, I'm celebrating today. I'm going to be out Monday. And up 61%. So really impressive gains there. Let's check out the NASDAQ. That is up 75%. And the Dow up 45%. Now that's the long term. Got to take a look at the short term here. We have seen the 10-year T-note yield heading higher. This is going to be a 2-month chart, and we are now up 8 straight days. And that's pretty significant because that can spell headwinds for stocks, but we're not necessarily seeing too much action today. US dollar relatively quiet. So let's take a look at the sector action, and then we'll get into some NVIDIA stuff. Financials, it is JPMorgan's day and some of the other big banks. That's up 1.25%. Consumer discretionary, as Brad just noted, along with utilities and tech, those are in the red. But let's take a look at the NASDAQ here. NVIDIA, a little bit of a downdraft, but it was so close to having a record closing high yesterday. Just off of that, here's the year-to-date chart. That was 3 months, and we are right there at the Rubicon. And I also want to take a look at IGV. That is the iShares software, tech software ticker, and see if I can find it here. But that has been at records, and I believe it just opened at another record. That should be good. And we can see that is heading higher after this big breakout. Here's a 3-year chart. You can really see that this is a nice cup and kind of handle there that it broke out of. Finally, want to take a look at crypto and specifically MicroStrategy. Sorry about that. Up 6% today. That has been leading higher. This is a 3-year chart. And here, it just broke to the upside, and I'm not sure if that is good for a record high. Here's a year to date. Probably is, and we know from history, MicroStrategy leads Bitcoin. Been talking about this all week. It's been a big topic on X and some of the social media. So Bitcoin, we'll have to see if it follows, guys.
We'll see if it follows. All right, Jared, thanks so much for breaking that down. Coming up, we'll be talking to a city strategist, Drew Pettit, about these moves at the open on the other side of the break. We'll be right back. We are looking at a mixed picture at the open. The Dow and S&P 500 moving slightly to the upside, still just above the flat line. You've got the Dow up just around 168. The NASDAQ, though, under a bit of pressure. Let's take a look at where big banks are trading after their third quarter results kicking off. You've also, actually, both are in positive territory. Now, JPMorgan up nearly 4%. You've also got gains at Wells Fargo up just about 5%. Third quarter earnings season is now underway, and we've got more banks on deck next week. We'll also see results from Johnson & Johnson and United Airlines. We'll get the first glimpse here for chip companies, ASML and Taiwan Semiconductors, and of course, the streaming giant and Netflix. Certainly there is a lot on tap. So here to discuss third quarter earnings season and the markets, we want to bring in Drew Pettit. He's a U.S. equity strategist at Citi. And Drew, I think if we just take a step back, not so much focusing on the results that we're getting out this morning, but more so the expectations for this earnings season. And I think after this massive run up that we've seen, do you expect to get that historical traditional bump that we normally get at earnings season, or will it likely be maybe a more muted reaction this time around?
So let's decompose this a little bit. Reaction, potentially more muted, especially for the growth side of the market, maybe not the value side of the market. And then as for like the actual results, we think they're gonna be better than normal. Look, we're in the US, beats are normal. That happens every quarter. But we actually think this earnings season is gonna be better than what we typically see. The offset is, and again, this is also normal, Q4 estimates normally come down. We just think they come down a little bit less than what's normal.
And so that's what I was going to ask. Better than normal by what metric? Because if it's forecast, then certainly you would expect that many names would be able to rally on the back of if there were enough big, large companies coming out and saying, hey, the economy is a little more resilient than we had expected, and we're either reiterating or raising our forecast, then that would potentially be looked at as a rising tide. Is that something you're expecting, or is it more so?
Actually, no.
Okay.
Sorry to cut you off there.
No.
But it's, no, we're not expecting that because you still have an election, you still have geopolitical concerns. And I don't know if we're completely out of the woods yet with Fed trajectory and macro data and so on. And you're talking about all these companies that have really high valuations. This is a great time for a CEO to just kind of level set a little bit, get the bar moved a little bit lower. And then what we're comparing to is we're looking at long-term analyst trends. We looked at 20 years of history. Almost every single year, Q4 numbers come down as Q3 numbers are being reported. So this time, likely not different, but a lot of good news priced in.
Drew, you mentioned the fact that we might not be out of the woods just yet. What is most worrisome to you at this point?
If you look at the manufacturing side short term, and you look at a lot of what our economists are talking about, you still have those PMIs that are sub 50, industrial production's just kind of hovering around 0. You're just not sure what's going to reignite things. The good news is the Fed started a cutting cycle, or we think they did. So people are willing to kind of look beyond maybe the next few months and start looking into 2025. But again, not quite out of the woods on the economic side.
With that in mind, I mean, we've heard this word from Delta CEO Ed Bastian as they were talking about earnings, expecting choppiness among the consumer. What does that choppiness look like and play out among other sectors that might not be as exposed to the B2C typical consumer, but have larger corporate spends that are tied to their revenue and tied to their bottom line as well?
And this is the beauty of the S&P 500 because you have a ton of that.
Yeah.
So while you're kind of worried about the economic cycle, the CapEx cycle, which drives AI investment, infrastructure build, that's a no cycle. And we think we're kind of in a CapEx no cycle. So that ends up being more resilient, and the S&P 500 ends up being less tied to the economy than it has been in the past. If we had this conversation in the 80s, I would have been 9 years old, but the economy would have mattered a lot more to earnings than it does today.
Drew, one thing that stuck out to me in the notes that you sent over is your view on software stocks right now. And I think that's a big question going in just in terms of the valuations, the lofty expectations, whether or not maybe it's setting up room for disappointment. What should investors be looking for there?
So on the software side, if you're looking to pick software stocks, I think you need to see follow through in the longer run expectations and estimates for the stocks. So when we look at software versus semiconductors, we actually think the amount of growth that's priced into those two industry groups is actually really similar. The difference is the semis are monetizing that now. You can actually see that growth. The software companies, their actual growth rates are a little bit lower. So we need those estimates to move higher to really justify how, where we're trading those names. So to us, I think a beat and hold in software is probably going to get beat up a little bit this quarter. Whereas a beat and hold or a modest miss, kind of like what you saw with some of the airlines and a lot of the value stocks, they probably don't get beat up as bad on a miss, and they probably get rewarded more, like the banks this morning, on good news, on good numbers.
How much can the software stocks, though, rely on the recurring revenue that they can show investors? Because if you're buying chips, yeah, you're going to kind of get a certain amount that's allocated for whatever data center and the operation that you need, and that's a purchase up front to run language learning models on top of, to run applications on top of those models. And then for the software companies, it's more of, okay, what's the service that we can offer you on top of that, and then show investors annual recurring revenue and then larger deal sizes in the future as well.
So this is the issue short term when they're in an investment cycle.
Yeah.
They don't really have the operating leverage that other areas of the market might have. We always think of software as super scalable, this is great, but when we look at top line deceleration in some themes like cybersecurity even, that's coming with margin degradation for the year ahead.
Interesting.
So you don't feel like they have really great operating leverage. So again, back to, if you're watching software, look for estimates moving higher, look for margin expectations moving higher, because if you're kind of picking in a space there that's really fully valued, you want to have some confidence in the fundamental trajectory.
Some good pieces of advice for our viewers to contemplate there as we head into the thick of earnings season. Drew Pettit, always great to have you. Thanks so much for stopping by in studio today.
Yeah, thanks for having me.
Coming up next, we're breaking down the biggest risks to the banking sector. That comes up right after the break.
Time now for another trending ticker, and you can scan the QR code below to track the best and worst performing stocks of the session. We've got Yahoo Finance's trending tickers page. All right, BlackRock, let's go there. BlackRock reporting earnings this morning, and we're tracking a record. The investment firm's assets under management, that AUM, hit a record high of $11.5 trillion. The world's biggest asset manager attributes the increase to ETF inflows. Investor inflows into ETFs hit nearly $100 billion in the third quarter alone. Shares rising right now by about 2.6% here.
Yeah, Brad, when I'm taking a look at the quick street reaction here, TD's Cowen, Bill Katz, he was out with a note here that basically saying that BlackRock's setting a very high bar that they expect few peers are likely to beat. So that really just puts BlackRock almost in a category by itself. We are looking at gains here of nearly 3%. Evercore's Glenn Schorr was also very positive on this print, saying that it was a strong third quarter here for the company that beat expectations, 15% year-over-year revenue growth on the back of better performance fees. But he did flag some issues here going forward. Higher expense growth, tax rate as a headwind here on top of that lower fee rate, saying that could be a potential headwind here, at least in the near term. Despite all that, maintaining that outperform rating on the stock, a $9.95 price target, which is just about $13 higher than where we are trading here today. So again, the initial reaction on BlackRock results very positive out from the street, and you're clearly seeing that reflected in that move to the upside here this morning. JPMorgan and Wells Fargo shares surging after reporting earnings today. Both banks' year-over-year profits falling less than expected. To discuss what risks might be ahead for the sector, we want to bring in Chris Whalen. He's Whalen Global Advisors Chairman. Chris, it's great to talk to you here. So let's just take a step back. Or I guess first, let's focus on JPMorgan, because it's been interesting trading action here out this morning. Before the bell, it was pretty much searching for direction. Now we're seeing this pretty substantial move to the upside. I'm curious what your big takeaway from this report was and how much we should be focusing on that net interest income beat and guidance.
Well, net interest income, I think, is an illustration of the fact that JP is well managed. Jamie Dimon has managed his duration, if you will, much better than the other large banks. Having said that, their revenues are down substantially from the second quarter, which was an unusual quarter. They're kind of in line with the first quarter in terms of the top line. And I think going forward, you're going to see managers go back into the stock because a lot of managers earlier in the year had withdrawn from the large caps thinking we were headed for a recession. It's not happening. Even though JP has built reserves are up over 100% year over year. They're still not at a level where you're going to be terribly worried. They're normal compared to the COVID years. So I think that overall, JP is going to lead the pack back up as the large caps come back into favor with the managers. We publish an index on the top 100 banks, and it was interesting in the second quarter, a lot of smaller names, American Express, Axos, Ameriprise, they all rose to the top. The best performing bank this year, by the way, is Dime Savings, up 50% year over year. So, it's been an interesting year. I think managers liked the large caps in the first quarter, certainly last year, but now not so much. The big risk is if we, don't get more rate cuts from the Fed, which I think is a likely scenario, by the way. I heard one of your guests earlier talk about President Trump possibly firing Jay Powell. That's not how it works. He can appoint a new Fed chairman, but he can't fire Powell. Powell's term as governor is set by the statute. So if you go back and look at Mariner Eccles 100 years ago when the Fed was trying to get their independence back after World War II, that's a good example. He stayed on the board. The president couldn't fire him. But he was no longer chairman.
So, Chris, just zeroing in more so on what this ultimately means here for the banks, because I think there was a lot of encouragement just in terms of falling rates, what that will do for loan demand, what that will do for IPO activity here down the line. It sounds like, just given that uncertainty, that maybe banks aren't in the clear just yet.
Well, banks are having difficulty getting assets. And what's happened is there's so much competition among the bigger banks for large assets, especially commercial assets, that the yields are falling. Now, the cost of funds isn't falling very much yet, so we're going to see compression. It's interesting, if you look at JP, the big growth was on the commercial side. The loan book grew substantially, and their yield on deposits fell. In fact, it's been falling for the last 4 quarters. What that means is that they're getting squeezed. So everybody is focused on the NIM print this quarter, but I think you want to take a step back, look at the whole year, and ask yourself, where is net interest margin going to be at the end of the year, first quarter next year, because I think you're going to see compression.
Coming into the start of this earnings season, especially for the banks here, Moody's had been talking about consumer loan performance data and their updates showing that banks' credit card and auto loan charge-offs are rising. They've also got strong residential mortgage asset quality that's going to deteriorate only slightly in the next 12 to 24 months. How do you see that translating through to the equity reaction for some of these largest banks and even some of the mid-tier ones?
The pain point for banks right now is on the commercial side. They really don't have much to worry about in terms of mortgage. Bank net losses on 1 to 4 family residential mortgages are negative right now because home prices have gone up so much. It's almost impossible to lose money on default for these banks. Autos, credit card have normalized, but you got to remember, credit card utilization is flat over the last 10 years. The banks would love to have more credit card business. Are the defaults rising? Yes, but it's not a crisis yet, not even close. So I think you got to look at the 15-year chart, look at what happened in 2008, look at what happened in 2020 with consumer when we gave everybody a moratorium. Remember, we weren't reporting defaults for 2 years. So now we're kind of elevated, but not worrisome yet. That's the big question mark for next year. Are we going to see consumer spike? Are we going to see home prices crack? My sense is we're not going to see a crack in home prices for probably another 2 to 3 years. It's a 2027-28 problem.
Wow. Chris Whalen, Whalen Global Advisors Chairman. Thanks so much for taking the time here with us, Chris.
Have a great day.
You too. Coming up, everyone, Yahoo Finance Catalyst co-host Madison Mills bringing us the chart of the day right after the break. Bank earnings kicking off with better than expected results, particularly in investment banking. What does this signal about deal making and IPO activity? For more, let's get to Yahoo Finance's Madison Mills. Hey, Maddie.
Hey, Brad, thanks so much. So pulling up our chart of the day here, this comes from Moody's, and they were taking a look at IPO activity heading into today's bank earnings and earnings season kicking off officially here. We got some positive numbers across the board from JPMorgan and Wells Fargo that are specific to deal making, so I'll get into that. But it really affirms the chart behind me here, right? You're taking a look at deal value and deal count, so both the number of deals and the value coming from those deals. That's going to be your purple bar here. You can see a small uptick from a year prior. Also, the number of sheer deals up ever so slightly from a year prior, but still you can see obviously huge declines from those highs back in 2021. There's been a little bit of a pullback in IPOs and deal making broadly because of the Fed's rate hiking cycle, among other things. Now the big question is, since the Fed is kicking off its rate cutting cycle, will we see a huge resurgence in deal making activity? Well, we got some clues about that from those bank earnings. Running through those numbers here, JPMorgan advisory fees up 10% to $847 million. That was above estimates to the tune of about $100 million. This could be boding well for other deal-making activity across other banks. Wells Fargo's number was huge here, okay? Investment banking fees up $180 million or 37%. So a huge potential upside there, not only in terms of what we've already seen over the past quarter, but what we could see here to come.
All right, Maddie, thanks so much for breaking that down for us. Coming in next, we will be getting a fresh read on the consumer with the University of Michigan's Consumer Sentiment Survey. That's out right at the top of the hour. We'll have that for you on Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, and we have breaking news out at the top of the hour. Preliminary reading on consumer sentiment data for October. That coming out, and a bit of a disappointment here relative to expectations. We saw sentiment falling from the previous reading, dropping to 68.9. That was below expectations. Again, the prior month's reading was just above 70 at 70.1. The median expectation or estimate was for 71. So again, coming in well below those expectations there. And of course, the big takeaway is what this tells us about the health and stability and really the confidence of the consumer right now. When you take that into account with the fact that we have been getting some mixed data out when it comes to inflation, and maybe the fact that that move lower, the softening inflation, won't be as steady as the decline that maybe many economists or strategists have been hoping for or expecting. When you see a print like this, consumer sentiment declining a bit more than expected there, obviously not necessarily too welcome news here for the market, but we're not seeing that large of a reaction here play out, at least right now in stocks, Maddie.
It's interesting, the one-year inflation expectations coming in at 2.9%. That is slightly above the prior reading here, which was 2.7%, and the estimate was also 2.7%. Again, that headline number you're looking at on your screen coming in at 68.9, below the expectation of 71 here. It's interesting, too, following the CPI print that we got and the PPI print as well, looking at some information indicating that inflation could be ticking back up again. I want to flip the board, if we can, from the control room over to Treasuries to take a look at how we're doing there, because we did see yields ticking higher on the heels of yesterday's inflation print, then ticking lower after the jobs print. You can see here a little bit of a mixed picture. You've got the 5-year and 10-year moving the downside a touch, but the 30-year yield just above the flat line there as we digest the consumer sentiment data coming in, again indicating inflation expectations perhaps a touch higher than anticipated. Well, as the market is digesting the latest economic data, we are approaching the 2-year anniversary of the bull market. So how could the health of the consumer impact market momentum going forward? For more on this, we've got Matthew Palazzolo. He is a senior investment strategist over at Bernstein Private Wealth Management. Matthew, it's great to have you on here. So as we're getting in this consumer sentiment data, a feeling out there that inflation is going to be higher for longer, how big of a risk would that be, if true, to this bull market rally?
Look, I certainly think that is a risk. Inflation and what that means ultimately for what the Fed does on monetary policy is probably one of the biggest risks that we see to this bull market continuing. You know, absent any surprises to the upside over further months and quarters, it's our expectation that the Federal Reserve will continue to cut rates throughout the rest of this year into 2025 and probably get the Fed funds rate down to about 3%, which would be a fairly conducive environment for equity investors. So it's our expectation the bull market continues into next year, but that the returns for equity investors probably are more modest than they have been over the last couple of years.
So maybe it won't necessarily be a repeat of what we have seen, those massive gains to the upside. Matthew, I think a lot of investors are trying to figure out what that leadership is going to look like, right? How much of a rotation we're going to see maybe out of these larger cap tech names, which sectors are best positioned at this point. How are you adjusting your portfolio then potentially for this next leg of the bull market?
Yeah, so I think we're certainly encouraged by the results in the third quarter. If you were to look at the returns across the S&P 500, there was much broader participation than there was over the previous quarters or even the previous couple of years. So that has allowed us to gain a little bit more confidence in our positioning. We tend to be very, very diversified investors, owning not just the top leadership names, but also those across the board where we find either undervalued opportunities or companies that maybe haven't been in the sights of broader investors. So we're thinking that we're going to continue to see more leadership out of the rest of the index. And if you look at valuations, that's supportive of that. The leadership that you've seen over the last couple of years, those companies are fairly expensive, and so we're seeing less expensive, more opportunity further down the line, and I think that continues like we saw in the third quarter into 2025.
Matthew, you sound like Jamie Dimon this morning a little bit. He talked about how market levels are slightly inflated and markets, sadly, they don't stay high forever. What are your thoughts?
Again, if you look at the S&P 500 in aggregate, we're trading north of 22 times forward earnings, which at least historically has been at the upper end of the range, but for bubble territory. But if you were to exclude those top companies, the Magnificent Seven or the top 10 names in the S&P 500, the market is not as expensive. And so, it's hard to look in aggregate. Again, the companies that are beyond those top leaders in the index are more in line with their long-term average. That being said, we're not expecting much more valuation expansion over the next 12 to 15 months. We think the major driver of equity market returns is really going to come down to earnings growth. Consensus earnings growth next year is for something like 10%, which we think is probably a tad bit optimistic. We're expecting something more like 6 to 7%. And so if you get no movement in PE multiples and the market just moves on earnings growth, you're looking at something like a mid-single digit return, which again, after 2023 and 2024, that's not so bad.
Matthew, how much does the Fed's policy play into this? And when we talk about the fact that we could see delays here in the rate cutting cycle, there's lots of focus on November, but looking out into 2025, how much is that really going to potentially weigh on earnings growth that we could see, especially next year?
I think once you move past an exogenous shock, which again can't be forecasted at all, the monetary policy and a policy error really does, in our mind, ends up being the number one risk. If the Federal Reserve stays at a level that is restrictive for too long, unnecessarily, given where the economy is, then I think that is the number one risk that could bring valuations down, cause a somewhat meaningful sell-off in the stock market, and probably more acutely hit the economy and the consumer and the unemployment rate. So again, once we get past an exogenous shock, then I think a policy error from the Federal Reserve sticking around too long at a restrictive policy is what keeps us up at night.
So some cautious optimism there, Matthew, but I am curious, given that we are approaching this 2-year anniversary of the bull market here that's really been riding on the coattails of AI. Then we had a lot of questions about the validity of the AI rally. How much is the continuation of this bull market dependent on the AI story continuing to stay intact?
I think in the near term or over the next year or so, it's not dependent on the AI story continuing to bear as much fruit as it has over the last 12 to 18 months or so. Longer term, we certainly think that artificial intelligence is going to benefit the broad swath of economies, not just the technology leaders. And so that'll have benefits to productivity, to GDP growth, to top line and bottom line. So we are optimistic about AI, but not necessarily that it's going to continue to be the main story or the only story through 2025.
All right, Matthew Palazzolo, great to have you here. Thanks so much for joining us. Bernstein's Private Wealth Management Senior Investment Strategist. Thanks, Matthew.
My pleasure.
As earnings season kicks off, Goldman Sachs out with a note on single stock volatility hitting record highs. They were talking about the movement that we saw last quarter, but they put in perspective for what we could expect this quarter. And Goldman saying that they expect volatility to continue this cycle, with options market implying a move of 6% on either side for stocks on earnings days. And I think that's very much what investors are trying to figure out, just how big of a movement we will likely see. There has been some conflicting commentary out from the street just in terms of whether or not this will be more of a muted reaction, I think, to earnings season this time around. I just asked Drew Pettit that exact question, and he was actually saying, and it was similar to what Goldman was saying, they are expecting these sort of outsized movements. And I think if you take into account why and maybe what this ultimately means, of course, there's a lot that is driving the market when it comes to AI, when it comes to rates, when it comes to the upcoming election. And that, of course, course, adding to some of this volatility.
And that's exactly what Goldman talks about in this note, right? The risks of AI, rates, and the election. Those three are the key potential drivers here moving forward. They talk also about single stock volatility on earnings events at a 14-year high last quarter, expecting earning day moves to continue to be elevated as we head into this earnings cycle. And this, again, is a look at the options market. Specifically, we could see movement in either direction here as you look at that chart that we had increasing moving forward. But I do think it's interesting and kind of notes sort of what we were just talking with Matthew about, right? This idea that it's not an everything lifting market moving forward. It might be an individual stock pickers market as well. So something we will, of course, continue to be talking about. Well, coming up, we're taking a look at some trending tickers on Yahoo Finance. We'll get you the news behind the moves. We'll also talk to one Tesla shareholder about that long-awaited cybercab. That's next right here on Catalysts. Let's get to some of today's trending tickers here. Scan the QR code that's on your screen right now to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, we've got Stellantis announcing CEO Carlos Tavares will retire at the end of his contract in early 2026. This comes just a day after the company announced plans to search for a successor for him, alongside the ousting of the company's CFO. And now this comes, Shauna, we talked about this a lot, but this is a company that has certainly been under pressure. You can see the stock under pressure today, down about 2.8% here. They've had sliding sales amid the broader challenges in the EV landscape and car landscape more broadly. You can see the stock down 30%. 36% over the last 3 months here. They've also had issues with bloated inventory and delayed new models. That's something that has been of particular issue when folks are speaking about the CEO's performance.
Yes, certainly. And this has been something that has been brewing, just whether or not we would likely see a retirement here or he wouldn't renew the contract when it was expired. And then, of course, coupling that with the CFO shakeup. It's been interesting with the street's reaction because I think given the fact that there was so much talk about maybe there should be a leadership change, you would think that maybe this would be viewed as a positive here for the company going forward. But I thought RBC's Tom Narayan did a great job of outlining maybe why that's not the case. And he talked about the fact that this tends to lead to a lot of uncertainty over the next couple of months or several quarters here as we do welcome in these new leaders, as we do try to find out who exactly will be replacing them. And then when you look forward, Maddie, to some of the issues that you were talking about, it's not necessarily something that you can fix overnight. When you talk about the swell that we're seeing in dealership inventories or aggressive pricing that they've had in North America, obviously challenges and a strategy that needs to see a significant shift and is going to take time to work out. And I think that's maybe why you're not seeing the initial, maybe more excitement from the street that maybe many had initially anticipated.
Well, and a huge move in their executive team. You can't fire the coach and the offensive director, whatever, on the same day.
Yeah. I mean, not a good look here, I guess, going forward. And then that's, of course, adding to that uncertainty.
Right, absolutely.
So we will see whether or not Stellantis and any other updates coming out from Stellantis, we, of course, are closely tracking here. Let's move on to Boeing. Boeing, the aerospace giant, filing an unfair labor practice charge against the union representing its striking workers. It's accusing union leaders of not bargaining in good faith. Just the latest in the escalating tensions between both sides. I don't know how much of the move really has to do with this filing here today. But again, it is interesting about the fact that Boeing seems to be going out on the offensive. And they're doing this because they're saying that the other side has not been bargaining in good faith, that they reluctantly have been forced to file these charges here in response to the machinist union and how those talks have progressed. And they say that they wanted to, I guess, depict an accurate, quote unquote, what they're calling an accurate picture of the events of the past few weeks. Now, the union saying, of course, that it is willing to talk, though Boeing needs to meet us at the table. And I think those two statements there just really show how far apart the two sides remain at this juncture.
Absolutely, and it makes a lot of sense when you take a look at the stock over the last day to see it moving to the upside off of this move to the offensive from the company's new CEO. Also, we heard from union laborers talking about the desire to kind of hear more from the CEO and be able to have a little bit more interfacing with him. I do want to see if we can pull up the 2-year chart for Boeing because the stock is at a 2-year low following the collapse of these talks heading into the strike that's been going on for about a month now. The workers recently losing access to health care and, of course, their paychecks, certainly adding pressure to the conversation. You can see here at the very, very end of your screen just a slight uptick at the end of the past 2 years here following this news and certainly other challenges from the company. It's up about 13% over the last 2 years, but still a huge decline from the start of 2024 here. And finally, Tesla unveiling long-awaited Cybercab with a $30,000 price tag. That was not the only product Musk revealed at the company's event last night. Yahoo Finance's Akiko Fujita joins us now with a look at Tesla's robots. Akiko, I know this is something that you have seen up close and personal. What can you tell us?
Yeah, we're talking specifically about those Optimus robots. This is a product that Musk has consistently touted as bigger than transport for Tesla. He has said that humanoid robots alone could boost Tesla's market cap to $25 trillion. The event last night marked the first public reveal for the latest version of the Optimus robot, but Musk has previously said that a handful of these humanoids have already been deployed at Tesla's Fremont factory. Here in Los Angeles, we saw those robots walking on the Warner Brothers lot. The first time we've seen these humanoids outside of company walls. Musk saying that he believes every person on the planet will come to own these robots in the future, though he didn't give a specific timeline.
So, and what can it do? It'll basically do anything you want. So it can be a teacher, babysit your kids. It can walk your dog, mow your lawn, get the groceries, just be your friend, serve drinks. Whatever you can think of, it will do.
The price point for these robots will be key to wide adoption. Musk saying last night that he believes the cost will be as low as $20,000 to $30,000. And that is lower than the price most experts have forecast. Robotic engineers I've been speaking with say this could be as ubiquitous as smartphones if it can sell for the price of a car. Now, the question is, of course, the timeline. It's worth noting the idea of human-like robots isn't new, but generative AI has supercharged their development. And Tesla faces plenty of competition in this space, especially from NVIDIA. The chip giant doesn't necessarily build the hardware, but it's created an ecosystem that allows robotics companies to speed up development. That means combining its chips, NVIDIA's Omniverse, foundation models that lead to faster learning. And that system is being used by more than a dozen robotics companies, including Figure AI, which is backed by OpenAI, Apptronic, a company we went inside for our next episode a few months ago. In terms of what this means for Tesla's bottom line, well, Goldman Sachs says the industry as a whole could reach a value of $38 billion. It's worth noting that we've already seen the initial use cases for this. Amazon's deployed its humanoid robot, Digit Robot, in a test facility. BMW's factory is using Figure AI's Figure Robot. And then Mercedes-Benz has a partnership with Apptronic, the company we spoke to as well. And guys, the thing that analysts have said consistently is that Tesla has the benefit of scale. It is difficult to scale operations like this, but they already have a manufacturing footprint. The key is, can they beat the market with a lot of these other competitors as well? The question I have to you is, would you buy one for $20,000 to $30,000?
It's a price tag
Something
was
to
a little
consider,
bit
I guess,
lower.
right?
I get that it maybe is lower than what the initial expectations were, but still a lot of money to spend. And I think given the fact that there's so much uncertainty, maybe getting people to buy until they really see the payoffs, it might be a tricky sell. I don't know. Akiko, what do you think? I feel like you would go out on a limb, maybe potentially purchase one.
I mean, I would try it, but just if you've seen these robots, like having something like that in your house, it's a bit of a leap, right?
Yeah, it is.
It's one thing to have your smartphone, but to have, a piece of metal walking in your house, a whole nother proposition. But we'll see.
I'm with you.
Certainly a lot of people excited about this.
Yeah, like Elon Musk said, they could be your friend. They did look cute for showing the video right now of them dancing up there. But again, this will certainly be an interesting story, to say the least, to watch. Akiko, great stuff. Thanks so much. The robots, well, they may be flashy, but Wall Street doesn't seem to be wowed by Elon Musk's plans for the company, at least right now. Joining us now is Tesla shareholder and Hamilton Capital Partners Chief Investment Officer, Alonso Munoz. Alonso, it's great to have you here. And we say the street doesn't seem to be too wowed because the stock price is off just over 7% today. I know you've been a shareholder for just about a year. What's your quick reaction to what we heard last night?
Yeah, good morning. Great to see you. Incredible dancing by those robots last night. It was fun to watch. It was very futuristic, and we've seen some of the negative headlines today. So we're just going to have to wait and see. I think that analysts and Elon Musk are going to have an opportunity to really hash this out on the earnings call coming up in the next couple of weeks. And that's something that we're going to be watching out for as the next catalyst.
Alonso, do you think then that the selling that we're seeing today, is this a bit of an overreaction?
I would say so. I mean, Elon talked about the implementation of autonomous driving in the Model 3 and the Model Y. So that would be interesting to see if consumers have a higher take rate on that software, and that's something that could certainly drive revenue. But certainly, I think an overreaction. We, in some ways expected this. The bar was set so high, but it was a really cool event. I think everybody would agree with that. Some really futuristic, cool-looking things. Robots were serving drinks. I mean, it reminded me of the movie iRobot with Will Smith back in the day. So it was, it was a great event. I think there's a lot to look forward to. But yeah, overreaction.
So it's interesting, though, because some of the, bears out there on Tesla, or just the skeptics, have noted that there wasn't a lot of detail on the full self-driving vehicles and full self-driving technology, rather. Goldman specifically talking about the lack of details. Are you concerned that they're not addressing it?
I mean, it's something that we're thinking about. I mean, we were more focused on how do they bring this out to their Tesla fleet that they have on the road right now. And I think we got a little bit of indication last night that this could be active in Texas and in California in their Model 3 and Model Y, but also in their other Tesla vehicles. We also saw some product lineup, right? The what they called the RoboVan, the Cybercab. And so, it's something that we're going to keep an eye out for, but we're really focused on Tesla's vehicle business. They have, different lines of business like their solar and energy. And so we're still excited about the long-term prospects.
Alonzo, there's lots of questions about that cheaper vehicle and how critical that is in order to boosting demand, and the fact that it might not happen now for some time. I think that could be a worrisome factor here for the street. Is that something that maybe you think is also a bit of an overreaction too, or I guess why aren't you too concerned?
Well, I think so too. I mean, in the macro environment that we're in, we saw consumer confidence this morning came in a little bit lower, and interest rates are still high. And so the affordability is a big question that I think analysts are mulling over. And when we look about vehicles, it's a major purchase for the consumer, whether it's their house or their vehicle. It's one of the highest costs. And so I think it would be smart for Tesla to roll out a lower entry-level vehicle at a lower price point, and as they look to continue to take market share. So it's something that we're looking out for. But again, we were excited to hear that autonomous driving in the form of full self-driving software is coming to their fleet, and that consumers will hopefully be able to access that in the next year.
Alonzo, if we can, I want to pull up a chart here taking a look at the 2-year performance of a company like GM when compared with Tesla. Thanks, guys. You can see Tesla under pressure in comparison with a more traditional name like GM. And we know that GM has been outperforming its competitors more broadly, but still that is kind of a substantial spread between the two. Do you think that's indicative of a broader challenge for Tesla, that some of the more traditional automakers are becoming some of their biggest competitors?
Well, absolutely. And Tesla's in a whole different ballpark. I mean, separate from legacy automakers, they're making electric vehicles specifically. They're not making hybrids, and they're not making gas-powered vehicles. So, it's a challenge. I think that both the macro environment, rates being high, the consumer holding onto their wallet, but also the adoption of electric vehicles across the globe. And again, it's been a challenging couple of years for the auto sector. You've seen some divergence in different companies. But for Tesla, we see it also as an energy company, as a software company, and the bar is set really high. I mean, it's baked into its multiple. And on a day like today, it's an opportunity for investors that want that exposure to that technology, to electric vehicles, to robotics and automation, to potentially get in at maybe not a discount, but at a lower share price.
All right, Alonzo, thanks so much for joining us. Appreciate it.
Thank you.
Well, coming up after the break here, we're speaking to an analyst on what Tesla's robotaxi event could mean for rideshare companies. Stick with us for that.
Tesla's highly anticipated robotaxi event leaving the street disappointed. We've got the stock selling off as a result. Shares earlier this morning were off the most that we've seen since August. And as the EV giant makes its reemergence or its emergence in the ride-hailing industry, we're taking a look at what this ultimately means for some of those that are already within the sector. Uber and Lyft. You're seeing shares of both Uber and Lyft moving to the upside here this morning. So let's talk about why. We want to bring in Roth MKM Managing Director Rohit Kulkarni. Rohit, it's great to have you here. So we're seeing gains in both Uber and Lyft. What is this a result of? Is it just simply the fact that the event last night was very late on details and now investors aren't necessarily seeing Tesla as a threat to these two names?
Yes, absolutely. You're right. This was an overhang on Uber and Lyft shares. Given this raises the kind of long-term terminal value of these companies. At some point, if robotaxis in the next 3, 5, 10 years are going to account for a significant percentage of mobility, then what happens to companies like Uber and Lyft? That's been a question that's been getting louder and louder over the last 3 to 6 months. And I think given Tesla and what Musk could be capable of doing, that became a pretty front and center investor debate. I think given what people saw yesterday, I feel it was a big relief and essentially reiteration that creating a scaled-up robotaxi business is not easy. It's going to be time-consuming, resource-consuming, and in the meanwhile, the only other two games in town are Uber and Lyft. So I think it reinforces that robotaxis, yes, that's a very shiny future, but it's much farther along.
So then, if that's a story for a later date, Rohit, is something like Waymo perhaps a bigger competitor to names like Uber and Lyft more immediately?
Yes, I think Google's Waymo has been taking more practical strides with both technical as well as regulatory sides of things. So they've been working on this for many more years than what Tesla has been working on. And they have proven out what a robotaxi business could look like. As far as profitability is concerned, it still is a very distant future possibility. But I think in the near term, the feasibility and the regulatory checkboxes are there. Uber has partnered with Waymo because at the end of the day, getting this product in front of consumers is also a big cost for some of these companies. So that's one somewhat of a hedge that Uber has. But I feel given Tesla as a big player, a potential big player is now off the table. That's the relief rally that you're seeing in Uber and Lyft.
Rohit, we're obviously seeing a bit of a relief rally here in these names today, and it clearly is a catalyst, at least for now. But looking down the line, are you confident that maybe the optimism that we're seeing play out in the market today, that's going to carry through? And I guess, what do you see as the next big catalyst for either of these names?
I think in terms of the way these companies are evolving from going only in mobility or maybe last mile delivery, they're becoming what most of the internet marketplaces had taken as the next step, which is advertising and subscriptions. So Amazon is the playbook that almost everybody likes to copy and envies a lot. They built out a simple e-commerce website, then they built a marketplace, then they built cloud, and then they built advertising. So advertising is the next step in all these companies' evolution, which helps them in two different ways. One is it attracts a different category of customers, and it is much more profitable than mobility or ride sharing itself. So I think next year's story in terms of positive surprises from a cash flow or a profitability standpoint is going to come from advertising, is going to come from subscriptions where these become habituated. And the longer term thesis here is look at how many teenagers or people in their 20s are not buying a car anymore. And that, as that generation goes through their peak buying kind of days, I feel Uber and Lyft stand to benefit a lot. But that's probably the medium term. But near term is advertising, subscriptions. Medium term is that generation trying to spend more.
Rohit, I'm fascinated by that. I thought that was just a thing here in New York City, and that was my East Coast bias. Is that a broader trend that we're seeing across the country, young people not purchasing cars and instead just using rideshare services?
Absolutely. Think about a kid who was in middle school when the first iPhone came out. Think about what their behavior and consumer, their kind of usage patterns are evolving to be. It's very, very unlikely that they are going to be essentially buying a car and getting it. Even when you look at the number of people who have a license when they turn 17 years old or 18 years old, that proportion has been declining steadily over the last several years. And if you just draw that out further, how that translates into buying a car and actually using that as your primary modes of transportation, I think Uber and Lyft are the big winners there. So yes, it is not just a big city New York phenomenon, but it is starting to slowly expand in various different parts of US, probably more in Europe as well, which is a structural positive for these companies.
All right, we got to leave it there, Rohit. Always great to speak with you. Thank you so much for joining us.
Thank you so much.
Appreciate it. We're about an hour into the trading day here. I want to take a look at the major averages. The NASDAQ reversing its earlier moves to the downside, up about 0.4%. You've got big gains on the S&P, up about 0.7% here, and the Dow continuing to move to the upside as well. Let's get a closer look at the market action with Yahoo Finance's Jared Blickery over at the Big. Hey, Jared.
Thank you, Maddie. I am looking at some Eastern stocks today and markets. Let's pull up the Wi-Fi Interactive, and we can see a little bit of red, although we're seeing a lot of green towards the left. Here, it was another negative day in China, although Hong Kong, it looks like it was up about 3%. But here we go. This is the overnight price action. I want to show you all 5 days. We peaked Tuesday, and then it was just all downhill. And in fact, the regular market there some markets were open, but regular markets were closed for about a week for the Golden Week. And this is a time when they kind of regroup. There were stimulus measures announced last weekend, and those had a negative effect on the market. We just didn't see a very good reaction to that, and that's evidenced here. Let me show you the year-to-date chart, and you're going to see what I mean. Big jump, but we've come down appreciably from those highs. And I can show you a longer-term chart in another Chinese market, which is the Shanghai Stock Exchange. And this is actually up 18% over the last month. But if I show you a 20-year chart, you're going to see how the market has basically done nothing over the last 5+ years, and it is just in a big trading range. You can see that when you pull up the 5-year here. So we're just in the middle, treading water. Doesn't mean a whole lot, the price action. You got to break out of this. And in that regard, there's going to be a meeting tomorrow, at least an announcement, 10 a.m. local time. This is going to be among the PBOC head and the finance ministry. It's a joint working group, and the authorities there are expected to announce fiscal stimulus measures. They've already done about $500 billion in fiscal and monetary. This is another $280 billion worth. But I would just remind people, and this observation comes from Macro Alf, that when we had that big 2008 crisis, a global financial crisis, that response was 20 trillion yuan. That was short of 3 trillion. All right, we're not even talking about 1 trillion today, and I think that accounts for some of the disappointment. And it's going to be really interesting to see what the magic number is that actually gets things to open in the green on Monday, if they can, guys.
All right, Jared, thanks so much for breaking that down for us there. Coming up, we're going to take a closer look at Nike, and analysts out covering Nike, talking about the potential catalyst for the companies moving forward. He's focusing in on that CEO transition. We've got that for you next on Catalysts.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Longtime Nike veteran Elliott Hill taking over the CEO seat on Monday. Our next guest sees the leadership change as a potential catalyst for growth for the company, upgrading the stock to a buy rating from hold. Joining us now, the analyst behind that call, we've got Joe Covello from Truist here. Joe, it's great to have you on. So talk to me about why the CEO change is a bullish signal to you.
Yeah, thanks so much for having me on. I launched on Nike about a year ago. And to be honest, through that period, a lot of people have been expecting, a turnaround to come up soon. They've been looking at it, the stock and think about, oh, this is an incredible brand. But we've seen some downside here, some sluggish innovation, et cetera. A few things have gone wrong, but they've been expecting a turnaround. It hasn't happened. With Mr. Hill taking the helm, I think he's a tenured industry vet. He knows the company well. He knows their partners. He knows the customers. I think, he can come in and, make some changes, really refresh the business and do things that investors want to see. And with that, I think, we could see a pretty quick sentiment boost, as long as they can handle some of the low-hanging fruit that I think people are looking for.
How big of a boost, Joe, do you think that will be to Nike stock? And I guess, is it enough to overcome some of those product headwinds that we've been talking about for so long?
I think so. So like I said, over the past year, it seems like people were, to me, overly bullish on a quick turnaround or, things improving in a more rapid pace. This is a big business and the industry has long lead times. Things take time. I think we've finally gotten to a point where expectations are low enough, realistic enough to encapsulate that. So I think, signs of, better times ahead, brighter outlook will be enough to boost sentiment enough to offset, near-term earnings pressure that you might see from more aggressive marketing, investing in the right areas, things like that.
It's interesting because I know that Nike has been struggling for quite some time now on a variety of issues, but one of them is the challenges related to the consumer slowdown in China specifically. I guess I wonder to what extent a CEO is able to control or turn that story around.
Yeah, I mean, in China, they've been facing a combination of macro pressures. And, we think that other brands, whether they be, local Chinese brands or Western brands, are also, building out their footprints in China. So they've clearly seen a lot of issues there. And I acknowledge that. What I would say is, they gave a lot of color on the recent call about pressures that they have there. So I just think a lot of that is embedded in the stock at this valuation.
And Joe, I'm also interested in the relationship with wholesalers. I know also been and we've seen other competitors in the space, like an On Holdings, for example, really cutting out the middleman and finding success with direct-to-consumer. To what extent do you see that as sort of a requirement for Nike to continue to grow here?
I couldn't fully hear your question. I was cutting out a little bit, but I think I heard most of it. And I would say that, what's going on? From here, what I want to see is Nike focusing more in the wholesale channel at this point. I think they need to get back to the distribution points that, people are shopping in, because I think, people have wanted to get Nikes, but weren't able to find them in the venues that they're looking for them in. You could, maybe at a point in time, we would have thought there would have been a lot more growth on the D2C channel. People would have been flocking to Nike's website app. That's kind of what was expected a few years ago. It didn't really pan out exactly like that. And I'm not saying that they can't eventually grow with that again. But right now, I think the focus should be on meeting the consumer where they are rather than trying to draw them to your own channel.
All right, Joe, apologies for the audio issues. Thanks so much for hanging in there with us. We appreciate you giving us some insight ahead of the CEO change that's happening and taking effect next week. Coming up right after the break, we're going to be taking a closer look at NVIDIA. NVIDIA hovering and not too far from record highs. We've got more on that next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts. Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Now time for more of today's trending tickers. Scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. We want to take a look at NVIDIA. NVIDIA, one of the most top searched stocks here at Yahoo Finance today. We're looking at a bit of a move lower, but the story all week has been the fact that we're very close to those record highs, given the fact that we've seen this continued excitement around the AI boom. Analysts reiterating their buy ratings on the stock, citing revenue from its new Blackwell chips and new funding for AI startups. The stock also getting a boost after Taiwan Semiconductor, which is one of its manufacturers, reported better than expected sales. So exactly what maybe this ultimately means here for demand down the line. That has, of course, been the driving factor for NVIDIA. I think the question is any sort of the fact that it could maybe not live up to those initial expectations on Blackwell that have been a bit of a headwind or a challenge here that analysts have been talking about now for quite some time, but that narrative has certainly shifted. We've heard from CEO Jensen Huang reiterating time and time again that he's very confident in the demand there. He quote unquote called it insane demand for Blackwell chips, and that was enough to get any of those, or seems to at least for now, convince any of those naysayers that NVIDIA's momentum still looks like it will continue here to the upside, Maddie.
I mean, it's interesting given just the degree of movement that NVIDIA causes too globally. I know we talk about this all the time, but I've got a note in front of me here noting that NVIDIA represents 15% of global equity volatility. That is in every stock market in the entire world, every major index. NVIDIA alone is responsible for 15% of global volatility. Also, you mentioned Taiwan Semiconductor. NVIDIA has been responsible for about 25% of the market gains here in the United States year to date. But you can see, again, that global impact, right? TSMC's gains obviously continuing to move to the upside off of that revenue that we talked about earlier this week. Taiwan Semiconductor is responsible for 75% of the year-to-date rally in Taiwan's index. So just giving some examples of how just NVIDIA's growth story continues to be huge, not only here in the United States, but also more broadly, and NVIDIA being really the clear AI beneficiary. That's what Goldman Sachs is calling it as of yesterday here over at their equities team, saying that growth can continue to be expected into what they call AI phase 2 multiples, but they still recommend being selective within some of those AI stocks. All right, well, NVIDIA-backed CoreWeave is securing a new $650 million credit line. The GPU cloud provider is planning to use that credit to expand its business and data center portfolio. Now, the company is raising nearly $13 billion from equity and debt in the past 18 months. And I just want to take a look here because, again, that $650 million credit line, it's coming from the top banks on Wall Street, right? So a key indication of some optimism around it. I'm talking JPMorgan JPMorgan, Goldman Sachs, Morgan Stanley leading the financing, but we also had participation from Barclays, Wells Fargo, Citi, and some others as well. Now, just to speak specifically about CoreWeave, the company is saying it's raised over $12.7 billion from equity and debt investors in just the last 18 months. So certainly a lot of optimism around this name following a funding round back in May, which led to a $19 billion valuation as well.
Yeah, you might be actually asking yourself maybe why NVIDIA has taken a stake within this name or investing, backing a name like CoreWeave in the past. And it almost so much solidifies their dominance there going forward, making sure that their technology continues to be deployed and widely used. When it comes to some of the ambitions here from CoreWeave, they have been very ambitious. 28 data centers across the U.S. and here abroad. They have planned to build another 10 data centers when you look ahead to 2025. It has supplied Microsoft and the French startup Mistral with GPUs in the past. So questions about maybe what that revenue and what their business looks like. That's reportedly right around $2 billion in revenue contracts lined up for this year. So again, this backing, then further expansion plans may be ahead for CoreWeave. And just given the chat that we were just having on NVIDIA and so many of these AI names, clearly that appetite and that demand for AI is not going anywhere anytime soon.
Yeah, absolutely. And it's certainly driving the markets here as we head to that 2-year anniversary of the bull market. But let's take a look at how markets are shaping up today as we head into our 11 a.m. hour here. You've got green across your screen, the NASDAQ paring back some of its earlier gains, but still continuing to move to the upside. The S&P 500 up about 0.5%. The biggest gainer sector-wise today, financials, no surprise, coming off the heels of those bank earnings, up about 1.9%. Interesting to note, though, the biggest drag on the S&P at this time is tech. And it's interesting to see that given what we have been talking about here, the tech rally more broadly. We're seeing weakness in Broadcom, Salesforce, and IBM. Those are the biggest market cap and weighted names on the S&P that are driving down the tech sector right now. So interesting to see some of that weakness, particularly in a chip name like Broadcom here. We will continue to monitor that movement and more for you throughout the day here at Yahoo Finance. But coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith has you here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Now, on today's show, the third quarter earnings season, it's underway, folks. Two big banks reporting today. We're going to zero in on falling interest rates and banks calling CDs. That's high-yielding CD that could be called or redeemed before its maturity date. And mortgage rates rising sharply last week, a new challenge for house hunters and potential refinancing candidates. We'll discuss with the NAR chief economist, Lawrence Yoon. Plus, we're going to talk about Social Security's cost of living adjustment, COLA, as you know it in your hood, and how it will affect older Americans and retirees. All that and much more. But first, we got to start here. U.S. banks, they got earnings season underway while markets also weigh the likely impact of a hot inflation print. Consumer prices rising a smidge more than expected in September as producer prices hold steady. With inflation risks slightly peaking out and earnings season kicking off, we're looking at how you should ready your portfolio. We've got Katie Kaminsky, who is the Alpha Simplex Chief Research Strategist and Portfolio Manager here. So, Katie, first and foremost, as we think about some of the keys to the trade here, we got to think about, first and foremost, the earnings season as we laid that out. What should investors be watching for, and what is the common denominator among banks, even as we evaluate that theme?
Well, I think the exciting part is earnings season is looking positive, and if you look at the data today, you're also seeing very positive earnings data from JPMorgan. So I think these are just more indications that the growth in the U.S. and the economy is actually pretty resilient and doing reasonably well. So I think that's a positive sign for any investors who were concerned about recession, concerned about weaker economic data in the last few months, which has been kind of the story back and forth since June.
And so a lot of people are going to think about earnings season and they'll think, well, wait a minute, I thought earnings season was all about semiconductors. I mean, as we're kicking off this fresh earnings season and we've heard and started to hear from some of the banks, how much focus do you think still lingers around the larger AI theme and the AI trade?
Well, I think so much focus is in the AI trade because it's new, it's exciting, it's also a very saturated trade and everybody's in it. So I think that creates a lot of impact for just positioning for most investors. But what's been interesting for us to see is that there has been a rotation, some out of tech, but some of that rotation, is it going to continue? Are utility, staples, and other alternatives going to be an interesting way to diversify some of that exposure? But I do think just the pure size of that particular industry in people's portfolios is why it's still very, very important.
All right, so that's the earnings season setup. Want to really dive into another trade here that a lot of investors might be trying to best position around, and that's bonds. Where are you kind of evaluating the environment right now, especially as it relates to the Fed's cutting cycle as well?
So bonds have been very tricky, and we've seen a very tumultuous path this year with bonds. And I think in the last month in particular, in October, there's been a clear repricing of bonds. Let me highlight two factors. Number one, in a world where inflation is a little bit higher than what we're used to, bonds tend to be more volatile, and also they tend to vary in their correlation with equities from time to time. So for investors thinking about their portfolios with these two ballasts of stocks and bonds, in this world where bonds are more volatile, there's going to be two things they have to think about. One is they need to start thinking about what are good entry points for bonds. For example, you've seen that recently. You saw yields come way down, and today the 10-year is at almost 4.10. I'm waiting to see if you see some buying opportunities there, but people need to start thinking about if bonds are more volatile, when do you get in, when do you lock in those rates? And secondly, with that in a portfolio context, we need to diversify. So we need to find things that will offset some of those shifts in fixed income markets as we pivot towards cutting rates and getting to that normalization that the Fed has been talking about.
That's a great point. All right, so one more trade we want to evaluate here. Big events as Tesla, of course, puts the rest of the EV landscape on notice, says, hey, we got a cyber car that's going to be coming out, and this is going to be the new robotaxi of the future, in the future. In fact, 2 years out from now, it seems. And so as everyone's trying to evaluate what the EV play is right now, you've got your standard combustion engine vehicle producers of the past that are trying to catch up, but scaling back a little bit due to demand. And then you've got Tesla that's saying, hey, focus your sights on 2 years from now, and that's where you'll see more innovation from us. What's the thesis around the EV trade from your perspective?
Well, I think the EV trade is a tricky one. It's exciting because anytime you have a disruptor of that type that is going to go in and potentially disrupt a business model that exists already, there's a lot of uncertainty about that type of event. And so what's interesting to me today is just looking at how the market is dealing with that information. It actually sold off in Tesla, and also Uber and Lyft were up. So what I would think that means is that this is an exciting idea. We need to watch it, but we also have a lot of things have to be figured out for this to come to fruition. So I think it's really a trade you'll have to watch and actually see how can they navigate the regulation front, how can they handle some of those issues that disrupting this industry would require.
And we were talking about inflation a moment ago. I mean, this is something that also plays into the mindset of people purchasing vehicles as well. So I wonder, from the thesis around the EV trade, to what extent the consumer is going to play a very outsized role, given the demand profile that we've seen certainly change and shift so dramatically that anybody who's playing within this space on a manufacturing front has had to revise exactly how they're going to approach this market.
No, I mean, I think that's a good point. And just inflation and the overall level of prices for consumers, A, for purchasing a vehicle, B, for using these services like Uber or Lyft, it really changes the dynamics as price pressure puts pressure on consumers and changes their behavior. So I think we're going to have to watch and see, how does that evolve? And if inflation comes back, it will again change things. If vehicles continue to be more expensive, people are going to have to find alternatives, and that's where this could be a good trade.
Then you got to factor in of course, the insurance side of that equation as well here. Alpha Simplex portfolio manager Katie Kaminsky. Katie, great to see you. Thanks for joining us in studio.
Thanks.
Absolutely. Well, earnings season kicking off this week. Some of the biggest banks kicking things off. Plus, you had Delta yesterday. You had PepsiCo. Everywhere you look, as they would say on Full House. And companies have been facing a lot of macro headwinds. That means investors' focus might be a little different than usual. To discuss, we've got market domination co-anchor Julie Hyman. Hey, Julie.
Hi there, Brad. Indeed, we have earnings season kicking off at a very busy time. Not for earnings. And even in the face of that, we've got the S&P 500, of course, climbing to new record highs. But just to list a couple of the things that are taking investors' attention away from earnings, we, of course, have the ongoing debate about what the Federal Reserve is going to do when it comes to rate cuts. And some of the recent data is not making it any clearer between the jobs report, CPI this week, not to mention PPI this morning. So all of that sort of muddying the waters there. You've got the conflict in the Mideast that is dragging on, with implications for oil prices and then a ripple effect through the markets. You have the hurricanes, of course, that have been going on. You have the China stimulus or not, or is it? So a lot of back and forth to take investors' attention away. Again, even in the face of that, we've got stocks moving higher. When it comes to earnings themselves, one thing that we are going to continue to focus on is the so-called broadening of gains among earnings. Now, if you take a look here, this is the breakdown from Strategas looking at the Mag 7 earnings growth versus excluding Mag 7 earnings growth here. So important to consider, again, whether we're going to see the, I think we have it backwards, actually. This is the Mag 7. The bigger bars are the Mag 7, and the other ones are ex-Mag 7. So what we saw in the second quarter was 4.2% growth in non-Mag 7 companies, and then about 37% growth. So what you see here is growth slowing among the Magnificent Seven and kind of picking up, broadening out again with the companies overall. That said, the overall earnings growth for the second quarter was 11%. This quarter, it's expected to be 4.7%. So a sharp slowdown, and really the expectations going into this season are quite muted. We talked to Oh-Sung Kwon about that. He's a strategist over at Bank of America Securities, and he talked about what people are focusing on.
I think this earnings season is going to be pretty tricky. I don't think the big focus is on Q3. Everyone basically knows that Q3 wasn't a very strong macro environment. It's really about company's outlook on the other side of the curve now that the easing cycle has started.
So the implications of that Fed rate cut are going to be key here. And again, just to remind folks what we're talking about, and this is something you were just talking about with Katie Kaminsky, Brad, is what we've seen from the 10-year sort of falling down here. Yes, it's creeping back up now, but the overall trend has been lower. And if the Fed continues to cut, will likely, to some extent, continue to move lower. This is already having implications for the likes of a JPMorgan, for example, which, yes, reported earnings this morning that came out ahead of estimates, but those earnings are sort of peaking and coming down as rates go down because the company is not going to be making as much on the money that it lends out. And there are a host of implications for other types of companies beyond banks as well. So that's a theme that we're going to be watching very closely and focusing on forecasts, not just what we're hearing about the third quarter, Brad.
All right, big forecast energy indeed here. Everybody focusing in on that. Julie, thank you so much for breaking all of that down in the expectations. Everyone, also tracking falling interest rates here this morning. And falling interest rates have some banks calling back high-yield CDs, leaving investors with lower returns. Joining me now to break this all down, what exactly it means here, we've got Cooper Howard, who's the Schwab Center for Financial Research fixed income strategist. What do people need to know about investing in CDs, certificates of deposit?
Yeah, so I think there's a couple things that they need to be aware of when they're investing in a CD. When we like to compare a CD, one of the other investments that we usually compare it to is like a U.S. Treasury, for example, Brad. But understand that a CD is going to be something that is FDIC insured, up to $250,000 per bank per depositor. So we here at Schwab view them as relatively conservative investments because of that FDIC insurance. I think the other thing when you look at a CD, understand that it is fully taxable. So it is subject to state taxes as well as federal taxes. That's something that's a little unlike a U.S. Treasury. U.S. Treasuries are exempt from state income taxes, although they are subject to federal income taxes. And then for Treasuries, they are fully backed by the full faith and credit of the U.S. government. So credit quality of CDs tends to be very, very high because they have that FDIC insurance. Credit quality of also Treasuries tends to be very high because they are backed by the full faith and credit of the U.S. government. But we look at them as relatively conservative investments for a portfolio, Brad.
So what should people do? What should investors do if they own a callable CD?
Yeah, so I think they need to first be aware of, do they own a callable CD? I think that that's something that's kind of caught some people off by surprise. And that should be laid out in the terms of the CD contract. Usually you can find that either from your bank or if you purchased it from a broker dealer, it should be listed on your account statement. So that's the first thing to be aware of. Also, the issue with a callable CD is that it usually pays a little bit higher of a rate of interest than a non-callable CD. And the reason for that is that when you're investing in fixed income securities, and I would consider a CD maybe part of a fixed income security, you should be compensated for taking on additional risk. So if you're investing in something lower credit quality, longer term, you'd expect to get a little bit higher of a yield. And there is a risk per se with callable CDs is that it allows the bank to refinance and call that in a little bit earlier. So redeem that CD a little bit earlier. So if you had purchased a CD that maybe was a 3-year CD, this bank may decide to call that in 1 year after it matured or 1 year after it was issued, and you don't get the full income for those 3 years. You only got it for 1 year, for example. So as a result, a callable CD generally pays a little bit more in terms of an interest rate than a non-callable CD. What we found is that it's going to average between about 0.25%, so an additional 0.25%, all the way up to about 0.75%. The further out you go, the more a callable CD is going to yield relative to a non-callable CD. So the risk, though, is that if interest rates stay at where they are or they move a little bit lower, it's likely that that CD is going to get called. The bank, just like you or I would have a mortgage, is going to refinance that, and they can issue something at a lower rate of interest. So I think that, to your point, it's going to depend case-by-case situation on what the term of the CD is, but also just to be aware that, do you own that? And then looking at your overall financial plan, is that going to put a little bit of a wrinkle into it if it gets called early?
What is the best way to evaluate the yield that you would get in a CD versus a Treasury?
Yeah, so the best way to look at the yield on a CD versus a treasury is to look at the yield to maturity. So the yield to maturity is going to take into account the callability, is going to take into account the coupon on it, as well as the price. You also want to look at the yield to worst. So I think that that's a very important metric that will factor in the callability of it. Now, if you don't want to invest in something and you want to take the risk of it being called away early, then maybe consider non-callable CDs, or again, maybe consider US Treasury bonds. Those are, again, a very highly conservative investment because they have that backing by the full faith and credit of the US government, Brad.
Cooper, thank you so much for taking the time here today and the breakdown as well. Cooper Howard, who is the Schwab Center for Financial Research Fixed Income Strategist. Appreciate it. Thanks. Coming up, we're breaking down all things Social Security. That's right, sharpen those pencils. That's right after the break. Social Security recipients can expect a 2.5% cost of living adjustment in their payments next year. To break down all things Social Security, we've got Jen Jones, AARP VP of Government Affairs. Jen, great to have you here with us today. First, let's do a little bit of fact or fiction here. The COLA adjustment keeps falling. Fact or fiction?
Fact. So the cost of living adjustment is calculated based on CPI, right? Which, is a proxy for inflation. So lower CPI, lower COLA, which is actually a good thing for the American people.
And so as we were breaking down throughout the week where this is kind of stemming from and where this draws back to inflation, what should be the expectations then if the Fed is continuing to get inflation under control for future COLA readings?
So again, because it's, Social Security is one of the few federal programs that's inflation adjusted, it means that as we continue to moderate inflation, Social Security recipients will see their cost of living adjustment go down. But again, that is a good thing because that means you are paying less at the pump. You are paying less at the grocery store. You're paying less for everyday expenses.
And so is it enough? Is this COLA adjustment this year, is it being perceived as enough of an increase?
So, if you ask many retirees, they will tell you that 2.5% feels insufficient, right? AARP just released a survey earlier this week where 83% of respondents said anything below 3% is not good enough and not keeping up with inflation, right? But we know that this is tied to the consumer price index, right? So what we typically tell our members and older Americans when they ask is like, listen, this is an automatic increase. You don't have to do anything for it. It comes every year. It compounds, and what it means is that it's just every little bit helps. I mean, the vast majority of Social Security recipients are on a fixed income. Social Security is the primary source of retirement income for 40% of older Americans, right? And so the additional $47, $48 a month, which is what it will be on average starting in January, means an extra tank of gas. It's a few more items in your grocery cart. Every little bit helps. That reliable additional income really does matter for those on fixed incomes.
Yeah, $47 makes me a high roller at Wawa here. Want to continue with our fact or fiction. Social Security, for some generations later on down the line, and this is a hot button topic, Social Security is going to run out. Is that fact or fiction?
I know where you're going, Brad. So that is fiction. So as long as there are American workers earning wages and having payroll taxes taken out of those checks every month, Social Security will be able to pay a benefit. Now, I think what people are cluing into is, it's predicted that if Congress doesn't come up with a bipartisan, comprehensive solution for Social Security's finances, it won't be able to pay out a full benefit starting in 2035. It means it won't be able to pay 100% of the earned benefit, but it still will be able to pay something.
And then lastly here in our fact or fiction, customer service is not entirely as responsive as you might expect when filing for unemployment. Fact or fiction?
When filing for unemployment?
When filing for Social Security, excuse me, and trying to get even more of those answers that you need.
Yeah, so the Social Security Administration has struggled for decades with poor customer service. It's largely due to congressional underfunding, right? They've seen their budget slashed 17% in the last 10 years, and the number of people that they're supporting is increased by 22%. Staffing is at historic lows, right? So what AARP has been urging Congress to do is say, listen, we need greater oversight of that agency because we are hearing too much from our members that the customer service quality is so poor. I mean, people are waiting nearly 40 minutes to get someone on the phone. They're waiting 7 months for disability claims to be determined. And so we are asking Congress to do two things: increase oversight and to increase their funding so they can build their ranks, they can improve their tech, and provide the level of quality service that the 70 million Americans receiving Social Security deserve.
Jen Jones, AARP Vice President of Government Affairs. Jen, thanks so much for taking the time here today and doing some myth busting here with us and inserting some fact into the conversation. Appreciate it.
We appreciate it. Thanks so much, Brad.
Certainly. The U.S. government is out with quality ratings for 2025 Medicare health and prescription drug plans, which will affect the options that seniors have for the upcoming enrollment period. Yahoo Finance's Anjali Kemlani joins us now with the breakdown here. Hey, Anj.
Hey, Brad. So I know that you had Carrie on the other day to tell you what those changes were for Medicare Advantage, but let's break down what this means for the market. Now, we know that with all of these changes that have happened, seniors are facing a bit of a different year for the upcoming plan options for enrollment, and that's because of the changes that CMS made. So now what we have is a pretty significant shift in terms of the market players. Let's take a breakdown and look at which companies now can boast that a majority of their population is going to be in 4 or higher star rating plans. Aetna coming out at top, that's CVS's plan. Meanwhile, United Healthcare down at 71%. Humana, that's the biggest drop. Last year, they could boast somewhere in the upper, I want to say it was like in the 80s or 90s, and now they're down at 25%. Meanwhile, Elevance 40, Centene 47, and Clover Health says 95% of their population is in these high star plans. So that's good news, but that's going to shift the market significantly. So while Humana has largely enjoyed being the go-to for some of these really good plans with lots of robust benefits for seniors, we're going to see a shift in what is being offered as additional. Things like gym memberships are going to be going away. I know you know that part now. In addition, all those other really cool perks like the flex spending for food, the rides as well, all of that might be going away. So it's going to be really important for seniors to pay attention to that. But now this all shifts who the top dog in the market is. So United Healthcare has for the longest time been the majority player, 28% of the market in Medicare Advantage. Humana at about 20%. That number is definitely going to change in the upcoming year. United, it's important to note, is also suing the government for some of the plans that did get audited for their star ratings, even though they still have a pretty significant portion in some of these top plans. So they're still suing the government to find out if they can renegotiate that. CVS over at 13%, Elevance at 6%, and Centene at 3%. So even though Aetna, now CVS, has a pretty significant portion coming up in the upcoming year, we're probably going to see that number flip and see Humana flip in the upcoming year. So this market is going to look a little bit different than it has in recent years.
I'm so glad that there's not a camera on my face and the facial expressions that I'm making every time we get an update from you, because some of these are eye-popping here. And I'm sure for anyone who's enrolled in these plans, hearing these changes and needing to know these updates, it might be a little eye-popping, but thank you for breaking it down for us here as well. So thankful that there's no camera on me. All right, guys, coming up, all things mortgage rates. We break down everything you need to know before you hit those open houses this weekend. That's right after the break. U.S. mortgage rates ticking higher as expectations shift on the pace of Fed rate cuts. But the move in mortgage rates may not be as bad as it seems. Yahoo Finance's Danny Romero joins us now with more. Hey, Danny.
Brad, mortgage rates did edge up this week. We saw Freddie Mac report that the average 30-year fixed mortgage rate jumped 20 basis points to 6.32%. This is the biggest week-over-week increase since April. Now, this may sound daunting, but if we take a look at where mortgage rates were last year this time around, today's 30-year rate is more than 1% lower than it was this time last year. In October, mortgage rates were hovering around that 7%. Bottom line, more buyers might be on the sidelines right now. If you take a look at the daily mortgage rates right now, the 30-year fixed mortgage rate is hovering around 6.6%. That's according to Mortgage News Daily. And traders have been adjusting their expectations around the size and the pace of the Fed's potential interest rate cut that could be happening in November. So we're kind of seeing this movement in the bond yields right now, Brad.
And so we did get some more information this week during the Consumer Price Index report, of course. And a lot of people out there might be thinking, should what we saw in the shelter cost portion of that CPI print actually give any type of housing optimism right now?
Totally. I mean, I think yesterday's report from the CPI, the shelter aspect really did add a lot of optimism for housing. Economists for over 2 years has been expecting shelter to come down. And if we take a look, shelter ticked up 0.2% on a monthly basis in September. And then on an annual basis, shelter costs increased about 4.9% in September. That is down from the August yearly gain of 5.2%. So this is really what economists have been looking forward to, but it's also really important to note that the pace of rent increases is also not, it's slowing down. If we look at the median asking rent price right now, that rose 0.6% on a yearly basis in September. That's according to Redfin. It's around $1,600, but the influx of supply is really helping the rental market right now. And so this is good news and optimism for the housing sector.
Great breakdown as always. Yahoo Finance's own Danny Romero. We're going to continue the conversation. Mortgage rates surging in the biggest one-week jump since April. To discuss what you need to know if you're in the market for a new home, we've got a good friend of the show, Lawrence Yun, National Association of Realtors Chief Economist. Lawrence, thanks so much for taking the time here. Just help us break down your read-in on this week's data that is certainly impacting the housing market and the thought process, the mindset that many potential buyers may have going to some of the different open houses or going to the signing table this week.
Well, first thing to note is that Federal Reserve does not control mortgage rate. It only controls Fed funds rate. So I think some of the consumers were quite surprised from the time when the Federal Reserve did cut rates in mid-September to now, mortgage rates have risen because Federal Reserve does not directly control mortgage rates. It's the broader bond market. Nonetheless, mortgage rate 6.3% average this week. This is measurably lower compared to what it was in spring. It is much lower than what it was this time last year when we was bumping up against 8% mortgage rate. So improvement of almost 200 basis point in mortgage rate from 1 year ago. This is a great news for many consumers. Consumers can expect little bounce in mortgage rate, maybe a tick downward or maybe another bad news uptick. But I think the 6% mortgage rate will be the new normal.
And so with that being the new normal, what we've heard in the past is that we would need to see something closer to 5.5% for more supply to come into the market and for people who are sitting on existing homes to feel like that is a good enough rate for them to potentially get into a new home or take on a new mortgage elsewhere and list a home to put that on the market. So if we did see a longer run 6%, what does that spell out more largely and what is the time frame for prices starting to come down even further from here?
Well, people love their locked-in 3% mortgage rate or 4% mortgage rate, which they took in a few years ago. However, when they consider they have additional child in the family and they need a larger size home, that 3% mortgage rate is not that strong anymore. Retirees who are looking to trade down from the McMansion, there's always marriages, divorces, death in the family, maybe some elder, where sons and daughters inherit a property which they want to list it and sell it. So what we are seeing in the marketplace today, despite the powerful force of the lock-in effect, with each passing month, more inventory showing up, Right now, it is up about 20% from 1 year ago, and I think it will continue to increase because of life-changing events that every individual faces. So it's just inevitable that inventory will rise, and with mortgage rate much better than 1 year ago, we are beginning to see more buyers beginning to knock on the door. It's not a big rush, but it is an increase.
Aging population aside, as we're kind of continuing to keep tabs on the housing data, especially the anticipation of housing data coming out next week, what should people be watching closely for to get a general sense of where they should expect more supply to come on outside of even just an aging population, or on the other side, where we might see more efforts to make just home purchases more affordable?
It's all about trying to get more supply, Brett. You are absolutely correct. The homes became unaffordable when we were lacking supply. But as we have more supply, builders are making profits, they're ramping up construction, and interestingly, they're ramping up construction on affordable, smaller size home and not on those McMansion, which will provide more avenue for people to get into the market. But overall, the life-changing events is leading to steadily more inventory. So some of the frustrated buyers of, say, during the spring months, maybe they want to retest the market. There are more choices out there. Furthermore, mortgage rate is on their side.
Lawrence June, who's the National Association of Realtors Chief Economist. Lawrence, always a pleasure to speak with you and grab some of your insights. Appreciate it.
Thank you.
Certainly. Coming up, everyone, we look at the impact of Hurricane Milton on home and car owners. That's next on Wealth. It's been over 24 hours since Hurricane Milton made landfall, leaving wreckage in its wake across southwest Florida. We're looking at images of destroyed homes, ruined cars, streets covered in debris. Morningstar analysts estimate Hurricane Milton could cost up to $100 million in losses, putting it on par with Katrina in 2005. Joining us now with his insight, we've got Trevor Baldwin, who is the CEO of the Baldwin Group, an insurance firm headquartered in Tampa, Florida. Trevor, you let us know that you have about 400,000 commercial and personal clients that are in states impacted by hurricanes Helene and Milton. Do you have an idea of the magnitude of losses that could be attributed to these back-to-back storms?
Yeah, hey, Brett, thanks for having me. And our hearts go out to all those residents who've been impacted by these back-to-back storms. As you mentioned, we have about 400,000 clients throughout the impacted areas, many of which are without power, who are yet to be able to get back to their homes or vehicles to assess any potential impacts from damage. Importantly, as an advisor to our clients, so different than an insurance company, we're an insurance brokerage. And what we do is we help our clients assess risk and match them up with the right policies, with the right coverage to ensure that during these times, they will be able to rely on their insurer to help them get back on their feet and make them financially whole. From an industry perspective, right now, and it's very early, we believe that the insured losses coming out of Hurricane Milton could be in the $40 to $50 billion range, which is a significant event, but the industry is incredibly well. And as a result of that, should be able to respond effectively and be there for their policyholders. Certainly. And so what do you believe the impact from those back-to-back storms is on the insurance market and consumers? This is going to have a devastating impact on consumers, and it's certainly going to have a follow-on impact on the insurance market, as many insurance companies are going to absorb significant losses as a result. I think the other item to really note, and particularly for personal homeowners, is the protection gap that exists with flood insurance and home insurance. The traditional homeowners policy does not provide coverage for damage arising from rising waters. So you can think storm surge, you can think surface flooding. And that coverage is typically provided by flood insurance policies, the primary of which comes from the National Flood Insurance Program. But take Helene, for example. While there's going to be $10 to $15 billion of insured losses, we expect there was likely $20 to $30 billion of uninsured flood losses because of that protection gap and individuals who have not purchased those flood policies. Trevor, thank you so much for joining us here. And of course, we want to get some valuable tips continuously out to our viewers, those who are impacted and those who are trying to insure themselves as well in the process here. Trevor Baldwin, the CEO of the Baldwin Group, thanks so much for taking the time. Another area of concern for those caught in the path of Hurricane Milton, vehicle damage. But not all auto insurance plans cover flood damage. Our very own Rochelle Akufo is here with some of the facts. Hey, Rochelle.
That's right, Brad. And even as we're looking at some of the images there of people sort of driving through that stormwater, do keep in mind that if your vehicle gets storm-related damage or is totaled during hurricane season, there are some key do's and don'ts, with a caveat, of course, to check the specifics of your policy. So first of all, do check your coverage and the deductible that you'll have to pay up front when you file a claim. Now, typically, comprehensive insurance will pay out for storm-related damage, and that includes flooding, falling objects, fire, even resulting vandalism or theft. It's usually optional though, unless you're financing your vehicle through a lender, and it is more expensive. Now, you can't apply this retroactively, so if you get comprehensive insurance now and try and backdate it, it usually won't cover it. And something else to keep in mind, some of these aftermarket add-ons that the automaker didn't install, say if you added your own GPS or custom stereo system, typically those are not covered. But you should definitely first contact your insurance company to file a claim as soon as possible. Preferably use the company's app, website, and chatbots, as their call centers do get inundated and some of those wait times are going to be much longer. Also, take pictures and videos of the damage, and also keep in mind anything that can't be recorded, like the smell of smoke and damp or mold, things that wouldn't show up in a video or a picture. Also, do get your vehicle inspected by a professional before trying to drive. This is so that you don't worsen any storm-related damage that you're not aware of, and also stop you from getting injured. And it's especially true if you own an electric vehicle. Now with EVs, especially if you're in Florida, salt water, it's corrosive, and if your car's been sitting in that water, those lithium-ion batteries can short circuit and catch fire. Now, it's likely that your insurer will total the car if it's been submerged in water, so keep that in mind, Brad.
And as you mentioned, comprehensive car insurance is more expensive. So if you don't already have it or can't afford it, what should people do?
As we know, it's not getting any cheaper. We did see in September CPI data that auto insurance costs are climbing. They're up 16.3% over the last year. So the 3 best tips for right now: if you must, tap into your emergency fund. This is what it is here for these things that are unexpected. See if you can check with a certified local repair shop. You might be able to work out a repayment plan for some of the repairs that aren't covered if you don't have comprehensive insurance. Also, check if you qualify for financial assistance with FEMA's Other Needs Assistance Program. Now, that's if the damage occurred in a federally declared disaster zone. So with that in mind, I know it's expensive, these extra costs, and these are the sort of things that people are trying to mix in with their financial priorities, but it does end up paying off in the long run to get that comprehensive insurance if you can factor that into your budget, Brad.
All right, Rochelle, excellent breakdown there and analysis. Yahoo Finance's own Rochelle Akufo. You can listen and watch Rochelle on Yahoo Finance's Capital Gains podcast, anywhere you find podcasts. That's every Friday, 12 p.m. Eastern Time. We've got much more on wealth after the break. You're watching Yahoo Finance.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the NASDAQ at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla's stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
If you were granted a tax extension by the IRS for the 2024 tax season, the deadline to file is Tuesday, October 15th. Here with some tips for those filers, we've got Andrew Gordon, who's a tax attorney, CPA, and partner at Gordon Law. Andrew, great to have you back on the program here with us. If someone isn't able to file by Tuesday, what should they do?
Thank you very much, Brad, for having me. It's always great to be on the program. And you're spot on. Next Tuesday is the tax deadline. And unfortunately, there are no more extensions. But if you cannot file, it's typically because of one of two reasons, or both. It's either because you can't file, you don't know how much you owe, or you can't pay. And so if you don't know how much you owe because you don't have a tax document, you haven't completed your bookkeeping, or for whatever reason it may be, it still makes sense to file with an estimate and later amend. And that's because there is a substantial penalty for failure to file. In fact, the penalty for failing to file is 10 times the penalty of failing to pay. The failure to file penalty is 5% per month that you fail to file. So if you can file as soon as you can after the deadline, that's still better than waiting longer and longer. And if you can't pay, it still makes sense to file as soon as you can. In fact, the IRS is willing to work with most taxpayers on a payment plan and allow you to pay over time. And so if you're holding back on filing because you're afraid you can't pay, you don't have the money now, that's not a good reason not to file. You should still file because you'll save yourself substantially on penalties.
So how can someone set themselves up now ahead of the 2025 tax season so they don't end up falling behind again?
Yeah, one great strategy is to pay estimates quarterly. If you know that you're going to have a tax balance at the end of the year, both to reduce potential penalties and interest, and also just to help with your own cash flow, it may make sense to pay quarterly estimates based on what you either owed the prior year or what you think you'll owe this year. And that way, when tax time comes or even the extension deadline comes, you're not worrying because you don't have the money to pay.
Switching gears here, the FBI is raising awareness around financial scams. How can consumers detect and avoid scams online and in the real world?
Yeah, you know, Brad, I'm glad you asked. This is something that we get calls for, unfortunately, every single day, and I'm not exaggerating. This is a billion-dollar-plus scam that's going on, and it's generally referred to as a pig slaughter scam. And so you can often detect these because they have a few common characteristics. You'll often get reached out to on social media. Someone will send you a message, and it won't begin with a financial slant to it. It will begin talking about either friendship or even perhaps romance. But over time, they will show you that they've been able to make a lot of money, often with a crypto or other related financial investment, and urge you to participate as well. And over time, it will look like you are making more and more money. But this is all fake. It's referred to a pig slaughter because they're trying to fatten you up. They're trying to have you put more and more money into the scam. And so if you're getting reached out to online by someone that you don't know, you should never just take that at face value, and you should never invest just based on the advice of someone online. If it sounds too good to be true, it almost certainly is.
And so if you suspect that you have been scammed, what can you do to recover losses?
Well, after 2018, it actually got more difficult. The Tax Cuts and Jobs Act reduced a tax deduction for thefts or casualty losses. So previously, you used to take a casualty loss and write it off. Now, there are still some options. Some tax options are such as a capital loss. For instance, a lot of people are being required to buy cryptocurrency first and then contribute that crypto to the scam. And so that crypto potentially could be written off as a capital loss. Now, years ago, after the Madoff Ponzi scheme, Congress enacted a Ponzi scheme deduction. And this might apply. It doesn't exactly fit the definition, so you might want to talk to a tax professional. But the Ponzi scheme deduction could also apply. And a third potential avenue is the Section 165C2. This generally applies to for-profit investments. And so it could apply here and provide a deduction as well.
Andrew Gordon, tax attorney, CPA, and partner at Gordon Law. Andrew, always a pleasure to get some of your insights. Thanks so much.
Thank you very much.
Certainly. Everyone, that's it for Wealth. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lifton. That comes up 3 p.m. Eastern Time. They'll count you down to and through the closing bell.